Hello and good morning, everyone. Good morning. Welcome to this amazing Saturday morning. Yes, 2 days to left for your 2 days to go for your examination. Yes, very critical time for all of you guys, all the CMA final students. So, am I audible and visible to you? Please comment in the comment section. Am I audible and visible to you? Good morning. Good morning, Sindhu. Good morning, Pawan. Good morning, Madhumita, Sachin, Sisodia. Please confirm if I am audible and visible to you. Good morning, Suyog. Good morning, everyone. Please confirm if I am audible and visible to you. Yes, welcome to this beautiful Saturday morning. 2 days to go for your final examination. Yes, everyone is saying yes, you are audible and visible. So, welcome, guys. Good morning. Welcome to this marathon lecture of SPM theoretical portion. As you are aware, from BVM, theoretical portion will come in negligible paramount. I mean, it will come very less. Maximum 2 marks, 4 marks, that's it. But from SPM, theory portion comes for at least 20 to 25 marks. Yes. For about 20 marks, theory portion will come. Theory chapters are relevant. For at least 20 marks, theory portion will come in your Strategic Performance Management SPM Group 4 CMA Final. So today in this marathon lecture, we are going to complete the entire syllabus of theoretical chapters of SPM, which will include primarily 3 study notes. Study note number 1, study note number 2, and study note number 4. Guys, in case of study note number 3, which is economic efficiency, you need not study the theoretical portion. Why? Because from that particular chapter, theoretical portion will come for say 1 mark or 2 mark, and to study the entire theory portion for that 1 mark or 2 mark might not be worth it. So from chapter number 3, theoretical portion you may avoid. Theory portion is important for 3 chapters. What are those 3 chapters? Number 1, number 2, and number 4. Risk management, performance management, and performance evaluation. These are 3 chapters for which theoretical portion I'm going to cover in today's marathon, and very important. Trust me, these chapters will will be there in your examination in a very large extent as far as theoretical concepts are concerned. As far as theory is concerned, they will definitely come in your examination. So be prepared for the theoretical portion of these 3 chapters. And today's video, we are going to touch base with the theoretical portion of these 3 chapters. All right, good morning, everyone. I hope all of you admit cards are in your hands and you are pretty set to rock the examination center by your knowledge, by your presence, by your examination skills. Okay, so yes, let's start. SPM theoretical portion, and the first chapter that we are going to start today is Conceptual Framework of Performance Management. Now, first of all, you need to understand what do you mean by performance management. You need to understand what is this 50 marks portion SPM therefore strategic performance management. What is it therefore? What is the use of this particular chapter, this particular subject, half subject, 50 mark subject, which is there in your syllabus? What is the use of this particular portion, strategic performance management? Guys, the ultimate goal of each and every person in life is to achieve the desired objectives. There are certain objectives which you are chasing. There are certain objectives which I am chasing. There are certain objectives which any big conglomerate is chasing. There is a particular goal which any big organization is chasing. So everyone is chasing their goals in their lives. Life of a company, life of an individual, life of a partnership firm, life of an organization. Everyone is chasing their individual dreams. While everyone is chasing their own individual dreams, their own individual goals, guys, it is very important that we need to assess after a point in time what has been our performance. Have we been able to achieve those milestones which we have set for ourselves? Have we been able to give the desired performance which we wanted for ourselves? Is our performance up to the mark or not? Is our performance up to the mark? Are we attaining the level of expertise, the level of performance, the level of achievement that we always wanted to achieve? Are we doing that or not? And this precisely is performance management. We need to assess our performance. We need to assess whether we are able to achieve the desired results or not. And there are various modes, various ways of assessing whether we have achieved the desired targets, are desired performance standards or not. There are various ways of of measuring them. And in this particular subject, which is strategic performance management, we primarily aim at looking at those techniques, looking at those ways in which we actually measure our performance. What is the way in which we are measuring our performance? That is the whole focus of this particular subject called strategic performance management. Now, performance can be for a company, for an organization, for a partnership firm. Performance can also be for an individual, for a partner of of a firm, for a director, for an employee. So it is a multifold game. It's not a one area which we are going to focus on. We are going to focus on multiple areas like performance of employees, performance of an organization, performance of a management of a company, performance of financial targets and goals of a particular company. So we are going to see the performance management in its entirety. We are not only going to focus on, say, profits or growth or market standing. We are also going to focus on customer satisfaction, whether customer is satisfied or not from our business, from our product, from quality of our product and price of our product, whether a customer is satisfied or not. So all these things are covered in performance management, and therefore we are going to study performance management in this particular subject. So the first chapter that we are going to start today is conceptual framework of performance management. How would performance be managed? How would performance be assessed? And how can we improve the performance? This is the entire focus of the first chapter, conceptual framework of performance management. So let's start conceptual framework of performance management. So first of all, we need to understand what do you mean by performance management. So performance management is a continuous process of identifying, measuring, and developing performance in the organization by linking each individual's performance to the organization overall mission or goal. So if you talk about an organization, if you talk about a company, if you talk about performance of a big conglomerate, then guys, that performance is to be identified first. What are the performance standards? What are we trying to achieve? Then we are going to measure whether we have been able to achieve those targets or not. And then we are going to develop those management standards, those performance standards to the next level. We are going to develop the performance levels, and we are going to improve the performance levels if we have attained the earlier performance levels. So these are three aspects of performance management. Number one, identifying, measuring, and developing the performance. We need to identify the performance, we need to measure our performance, and we need to develop or increase our performance or grow our performance. This is known as performance management, and definitely it is a continuous process. It is not an year-end process that oh, at the year-end we will analyze whether our debt equity ratio was appropriate or not. At the year-end we will analyze whether our gross profit ratio was appropriate or not. No, it is not done at the year-end. It is done around the year. So month on month basis, I will analyze my performance. On a month on month basis, I will analyze my gross profit, net profit, and all the profitability ratios. On a month on month basis, I will analyze this. So performance management is a continuous process of identifying, measuring, and developing the performance of an organization. This is known as performance management. So two aspects of performance management are, number one, that it is a continuous process. It is a process which will go on and on and on. It is not a year-end process, annual process. You say that, oh, sir, after the year-end, we are going to assess our performance. No, that's incorrect. You have to assess your performance on a routine basis, on a regular basis, say on a weekly basis, on a monthly basis. So guys, even when you are studying, can you afford to say, oh, we will assess our performance when examinations will come? No, you have to assess your performance on a daily basis. How many hours of study have you employed on a daily basis? If you're in CMA Final, definitely you need to employ larger hours of study. So have you employed those larger hours of studies in your daily performance? That is how you assess your performance. So it is a continuous process. It is a process which goes on and on and on. So performance management is not an year-end or a one-time process. It is not a year-end process. It is not a one-time process. It is a continuous or never-ending process. It's a continuous process which goes on and on and on. And it is a never-ending process. It will never end. It will never finish. This will go on and on. It is a continuous process. Then it is linked to missions and goals. Always performance management is linked to some kind of mission. We have a mission in mind, we have a goal in mind, and that goal is very much the driving factor of our performance. Our performance will be directed towards our goals. So performance is linked to missions and goals. That is one very important aspect of performance management. So performance management will include, number one, it's a continuous process. It will go on and on and on. Number one. Number two, it is linked to the missions and goals of the organization. Whatever the organization goals are, to those goals and missions, this performance is linked. That is how performance management is driven. That is how management performance is there. So management performance is definitely characterized by two things: that it's continuous. Number two, it is linked to missions and goals. Of course, guys, our performance is driven by the mission that we have, the goal that we have. Okay, if we have the goal of qualifying CMA final, then obviously our performance will be up to the standard of CMA final. We cannot say that, oh, we will study only for 4 hours a day. No, 4 hours a day will not be sufficient for qualifying CMA final. For qualifying CMA foundation, it might be okay. For qualifying CMA foundation, it might be okay. But for qualifying CMA final, you have to put in at least 8 hours of study. That is how mission is linked to performance. Second is differentiation between performance management and performance appraisal. Now, there are two different things, guys: performance management and performance appraisal. So there was a time when performance management was considered to be, performance appraisal was considered to be the hit thing, but now a better thing is performance management. So performance appraisal is a narrower term. Okay, it is a narrower concept. Performance management is a broader concept. Performance management is a broader concept. Performance appraisal is a narrower concept. Performance appraisal is a narrower concept. Performance management is a broader concept. So what is the difference between performance management and performance appraisal? Guys, as you can see in the chart, by doing performance management, you can skyrocket your growth. You can fly like a rocket. You can shoot like a rocket. Skyrocket your growth if you are following performance management. But in case of performance appraisal, you will be standing where you were standing yesterday. Almost at that pace, you will be growing. You will not be growing at a very fast pace. So performance management, you will grow at a very fast pace. Performance appraisal, you will be standing where you were standing yesterday. You will not grow at such a fast pace. So as a rational human being, as a rational person, what would you choose? Would you choose performance management or would you choose performance appraisal? So many students are saying explain in Hindi. Guys, whatever is there on my YouTube channel, it is always in English. I've already told you the channel has both South Indian and North Indian students. Therefore, the language which I explain is only in English. So apologies for that. I cannot speak in Hindi because my South Indian students are also there on this particular channel. And let me ask you a question. Even if you are a student from North India, will you write your paper in Hindi or English? Yes, you will write your paper in English. So definitely, guys, you should adopt this language. I'm not asking you to speak, but at least whatever I'm speaking, try to understand it. If you do not understand what I'm speaking, how will you write in the examination in English? You're not a Hindi medium student, and your future is not demarcated by Hindi. Your examination will not be in Hindi. Your examination will be in English. Please understand, all the North Indian students also. Please try to understand English. I'm not asking you to speak in English, but at least understand what I'm saying. Because you have to write your answer in English. You are not going to write your answer in Hindi. So please understand, all my videos are in both the languages, Hindi as well as English. I have given you option for my videos. You have both the options. But for my YouTube channel, whatever videos are there on the YouTube channel, that is going to be in English only, because it is benefiting South Indian students as well as North Indian students. So if you want Hindi language lectures, you can take Hindi language lectures. But please understand this fact. Don't shy away from English. The problem is that all the students who are unable to speak fluently in English, they shy away from English. Don't shy away from English. Ultimately, you have to write your answers in English only in the examination. Please understand that fact. And for future purposes also, for your job, for your future career, English is a very, very important language to understand and to write. And in these lectures, I'm not even asking you to speak. I'm only asking you to understand what I'm saying. And if you are unable to understand what I'm saying in English, then you are in for a big trouble. You are in for a big trouble. So my earnest request is, please understand English. Please don't shy away from English. नहीं नहीं सर, आप हिंदी में ही बात करो तो ही हमें समझ में आता है, हमें समझ में नहीं आता हिंदी में. अगर तुम्हें हिंदी में समझ में नहीं आता तो एज अ प्रोफेशनल तुम्हें, अगर तुम्हें इंग्लिश में समझ में नहीं आता, एज अ प्रोफेशनल तुम अपने लिए एक बहुत बड़ा गड्ढा खोद रहे हो, अगर तुमको इंग्लिश में जो मैं बोल रहा हूं वो समझ में नहीं आता तो. So please understand this fact. Take it as an opportunity. Take it as an opportunity. Please understand English. Just give me 1 second, guys. Just give me 1 second. So yes. So Sushil Kumar Singh, Yash, Akshay Anand, a clear message to all of you. Clear message. Please understand English well. Otherwise, you are in trouble in future. My logic of speaking in English on my YouTube channel is my South Indian students. South Indian students are also there. They should also get benefited. North Indian students anyway knows Hindi and English both, so they are getting benefited. I want to benefit all the students at large. So please understand my logic of speaking in Hindi on my YouTube. I will both as well as in Hindi language. You can choose one of the language. I have both the languages of all my subjects. But for YouTube channel, English will be the preferred medium of communication. All right. So as a rational individual, what will you prefer? Will you prefer performance management or will you prefer performance appraisal? If given a choice, what will you prefer? Will you prefer performance management or will you prefer performance appraisal? Please answer in the chat box. Fastest fingers first. What will you prefer? Will you prefer performance management or will you prefer performance appraisal? As a individual, if I want to give you performance increase, okay, and I give you a choice, either you can do performance management or you can get your performance appraised. What will you choose? What will you choose? Obviously, Lavanya is right, Moshmi is right, of course, performance management. Mayuri is saying performance appraisal. Mayuri, you don't want to grow. Mayuri Patil doesn't want to grow. Samir Kundra is here. Samir Kundra is saying performance appraisal. Samir Kundra, I know you know the answer, but you are just making fun of us. That's why you are giving the wrong answer. Samir Kundra knows the answer. Okay, Sharan is saying performance management. Nikhilesh is saying performance management. Madhumita is saying performance management. Great. Shikha, performance management. Great. Awesome. Yes, guys, obviously, each one of us would require performance management. We would prefer performance management. We would not prefer performance appraisal. We would prefer performance management. We will not prefer performance appraisal. Of course, we want skyrocketing growth. We don't want slow growth. We want high growth. If you want high growth, then you have to definitely focus on performance management. You cannot afford to do performance appraisal. You have to focus on performance management. If you want high growth, if you want skyrocketing growth, then performance management is the key. Therefore, we need performance management. Now, sir, we understood that performance management is better than performance appraisal. So please tell us the difference between performance management and performance appraisal. Very good question. So let's see the differentiating factors between performance appraisal and performance management. The differentiating factors between performance appraisal and performance management. What is the differentiating factor? Number one, performance appraisal is a top-down assessment, which means what? It means that the person who's sitting at the top, he has, suppose, 3 juniors. 1, 2, 3. There is Mr. A. Mr. A has 3 juniors, B, C, and D. What is done in performance appraisal? Mr. A will review the performance of Mr. B. Mr. A will review the performance of Mr. C. Mr. A will review the performance of Mr. D. This is the concept of performance appraisal. So one person who's sitting at the top is appraising the performance of B, C, and D. He's telling B, oh, look, Mr. B, you did not do these things well. You did these things well. You did this. So Mr. A is speaking. This is performance appraisal. But what happens in performance management? It's a joint process through a dialogue. So in performance management, Mr. A doesn't speak at the first place. The first option is always given to the appraisee. The first option is always given to Mr. B. Mr. B is allowed to speak first. Mr. B is asked, Mr. B, please tell us, what did you do good? What did you do bad? What do you think should be improved in the organization? What did you think that, how did you perform? Mr. B is always given the opportunity to speak first. That is how it is a joint process. It is not a one-way communication. It is a two-way communication where B is allowed to speak, A is also allowed to speak. However, in case of performance appraisal, it is a one-way communication where the senior talks and the junior listens. In case of performance management, senior also talks, junior also talks in each of their turns. They will take their turns to talk. That is how performance management is a little more open dialogue. Performance appraisal is a one-way dialogue. Second, annual appraisal meeting. So this appraisal happens one in a year. Annually, it happens at the end of the year. Performance management is a continuous review with one or more formal reviews. So performance management is a broader concept. Here, the performance appraisal doesn't happen once in a year. It happens on a regular basis, which means, every month, the employee and the employer sit together and see what went right and what went wrong. So performance management is a continuous review. It doesn't happen once in the year. It doesn't happen once in a year. It happens on a regular basis, on a monthly basis, or on a weekly basis. It happens. So it's a continuous process. Then performance appraisal uses ratings. Ratings means A, B, C, D, A plus, B plus, C plus, or 1, 2, 3, 4, 5, 6, 7. This is the performance appraisal concept, use of ratings. However, in performance management, ratings are less common. The focus is not to rate an employee. The focus is not to give a rank to the employee. No, the focus is not that. The focus is to jointly see what can the employee do more. What has the employee did in past? What has the employee did in perfection? And in future, what can the employee do more? That is the concept of performance management. So performance management, ratings are less common. We don't give ratings in performance management. In performance appraisal, we rate our employees rank 1, rank 2, rank 3. Out of 5, you have got 3, you have got 4. This is how we rate in case of performance appraisal. Then performance appraisal is a monolithic system. Monolithic means it's a one-way dialogue and it's a rigid system, okay? Which means that there's a set pattern which is to be followed. Set pattern is at the beginning of the year, you set your goals. That, look, employee, you have to attain sales worth rupees 20 lakhs during the year. Look, employee, you have to complete at least 5 trainings which are provided by the institute, by the organization. So this is a monolithic system. It is not very flexible. So, whatever happens, it happens as per the format which has been established for performance appraisal. In performance management, it's a flexible process, which means that, if the manager feels that after each project, he needs to sit with his appraisee, or after each assignment, it needs to sit with its employees, he can do so. He can do so. After each project or after each completion of any assignment, the employer can sit with the employee and do the appraisal. There is no hard and fast rule that you have to do the dialogue only at end of the year or only at end of the month. No, it is not hard and fast. Anytime you can sit with your employee that, come employee, let us see what went right, what went wrong in this particular project. So it's a very, very flexible process. Performance management is quite flexible. Then performance appraisal focuses on quantified objectives. Quantified means numerical objectives, which deals with number. Number objective means, look, employee, you have to obtain sales worth rupees 20 lakh during the year. That is a quantified objective. That is a numerical objective. So whenever the focus is on numbers, it is related to performance appraisal. Performance appraisal only focuses on numbers. That how many numbers do you want to attain during the year? How many sales figure do you want to attain in number of year? That is the focus of performance appraisal. However, performance management focuses on values and behaviors also. So, what has the employee learned during the year? Apart from numbers, has the employee been able to develop integrity or, some skill set like communication skills, like, table dining skills, dressing up skills? All these skills, has the employee been able to develop those also apart from the numbers? What behavior change has the employee done in himself? Was the employee very aggressive at an earlier point in time and now he's very much calm? So what are the behavioral changes in the employees and what are the value changes which are there in the employees? That is also important in performance management apart from the numbers. In appraisal, we focus only on numbers. We focus only on mathematical numbers, the quantified numbers. That's it. That employee, you have to attain these goals. However, in performance management, we also focus on values. Behavior of the employees is also important. Then performance appraisal is often linked to uh, pay. So performance appraisal, the ultimate aim of performance appraisal is to determine the bonuses. If your rating is high, your bonus will be high. If your rating is low, your bonus will be low. That is the sole objective of performance appraisal. So ratings lead to pay increase. So the focus is only on pay under performance appraisal. However, in case of performance management, the focus is less on pay and more on employees development. It is less on pay. We are focused less on pay. See, pay is a very secondary thing. If the employee develops necessary skills, if the employee works hard, pay will follow accordingly. Remuneration will follow accordingly. Remuneration will not be a problem where the employee is working hard, right? So in performance management, the linking is not with pay. The linking is with the overall development of the employee. The employee is being asked, please tell us what changes have you found in yourself as compared to last year. This is the question which is asked in performance management. In performance appraisal, the question which is asked is, your salary was 6 lakh rupees last year. What is the salary current year? That is the question which is asked in appraisal, because the focus is on money. In management, focus is on development of the employee. How has the employee developed over the years? Next, bureaucratic. There's a complex paperwork. Okay. So in performance appraisal, there are a lot of forms to be filled. So first form is during the start of the year, goal setting form. It is known as goal setting form. You have to fill the goal setting form. Then when the year end comes, then you have to submit your self assessment, and then the senior person gives you review of your work. So everything is documented, everything is paperwork. So it is very, very orthodox and a bureaucratic manner, just like government offices, paperwork is too huge. So that kind of paperwork is there in case of performance appraisal. However, in case of performance management, documentation is minimum, dialogue is more. Documentation is minimum, and please write over here, dialogue is more. Dialogue is more. We communicate more and we document less. Okay. Now this process is owned by the HR department. So HR department, follows up for this entire process, develops this process and takes forward this process. However, performance management is a line manager duty. Line manager means the immediate manager of a particular person. He will drive the performance management process. He will decide when the meeting will happen between junior and senior for his performance appraisal. So everything is driven by the line manager. HR have less control in performance management. However, in case of performance appraisal, everything is controlled by HR, because HR will determine the timelines of filling the goals, will determine timeline of appraisal, etc., etc. So HR is sole responsible for appraisal. In case of management, everything goes in hands of the managers. Managers decide when to sit for appraisal. Managers decide how frequently should we sit for appraisal, which form to be filled, which form not to be filled. Everything is decided by the management of the person. That is the difference. Now, what is the performance management cycle? The performance management cycle, how do you do performance management? First of all, you need to plan, that is set your goals. Then you need to act, doing your job and developing yourself. Then you need to monitor. Monitor means what have you done well, what have you learned in the organization, what have you done well, are you getting coaching properly? Then review. Review means you get your final appraisal or final performance related comments. That is the process. So plan, act, monitor, review. Plan, act, monitor, review. This is the performance management cycle. So the components of performance management, first of all, is planning. You need to plan the targets. You need to plan the key performance areas which you want to achieve. Then there are certain key performance indicators which you decide for yourself, key result areas that you decide for yourself in planning phase. So for example, if you are an employee of, say, a sales department of a company, then you will decide that your key performance area is developing sales, having more and more sales. Okay, that is your key performance area. And what is the key performance indicator? How will we indicate that you have done well? So if you have done sales worth rupees 5 lakh, we'll give you C rating. If you have done sales worth rupees 10 lakh, we'll give you B rating. And if you have done sales worth rupees 20 lakhs, we'll give you A rating. This is how your performance indicators will tell us what was your performance in the key performance areas. Your key performance areas is sales. Similarly, there can be various key performance areas like managing your juniors. How good are you in managing your juniors? That can be your key performance area. What will be the key performance indicator in that case? Key performance indicator will be how satisfied are your juniors? Are they happy with you or are they sad with you? That is the key performance indicator. All right. So the first one is performance planning. The second one is performance appraisal and review. Now, after your performance is planned, then you appraise your performance and review your performance. Self appraisal is required first of all. So I've told you in management, in performance management, first of all, an opportunity is given to the employee to rate himself. What does he think that he has performed good, or what is the thing that he has performed not so good? It is employee's prerogative that is required to be done. So the first performance level indicator is self appraisal. Appraisal is to be done by the employee himself. Then he gets the final rating for his achievements by the employer. That is the performance appraisal and review process. Feedback of performance followed by personal counseling. Now, once the person gets the final rating for his achievements, now he will talk with his senior and he will get counseling on how to improve the performance. Now, suppose current year the sales were 20 lakhs. How to increase those sales to 30 lakhs and 40 lakhs? What are the areas of improvement? This will be discussed between the manager and the employee. Both manager and the employee will be KPIs and KRA. Yes, KPIs and KRAs are part of a performance appraisal as well as performance management. Both are a part of both of them, performance appraisal as well as performance management. But currently we are studying the components of performance management. So component of performance management will contain KRA and KPI. This will also be there in components of performance appraisal, but we are not dealing with performance appraisal right now. We are dealing with performance management. Performance management is our area of focus in this particular chapter. Okay, sir. Next is rewarding good performance. Now, whosoever has done good performance, whosoever has given good ratings, reward should be given to them in form of high bonuses, in form of recognition, public recognition that yes, this is the employee of the month. You know, sometimes you see employee of the month recognition, and bonuses should be given to employees for their self-esteem and motivation. Then performance improvement plans. We need to prepare the performance improvement plans. How can you improve the performance at a later point in time? Those plans are required to be made for the next year. So fresh goals are set. Fresh goals are set for the next year. For the next appraisal cycle, fresh goals are set. Potential appraisal. Now, what is to be seen over here is promotion. Promotion forms an important part of appraisal, right? Now, what is the probability that we can give promotion to the employee? Latent or vertical movement to the employee. Can we promote him to the next level? Bonuses is okay. You're giving bonus for good performance. That's perfectly fine. But can we promote this particular employee to the next level? That is a question which we need to answer. And to answer that question, we need to discuss about potential appraisal. Potential appraisal means, can we promote the employees? This is known as potential appraisal. Appraisal that you are going to do in future for increasing the level of the employee. Lateral and vertical movement of the employees. This is potential appraisal. Okay, sir. So now let us come on to what are the measuring tools of performance. How will we know whether we are performing well or not? As an organization, how will we know whether we are performing well or not? As an individual, how will we know that whether we are performing well or not? Okay. So next is how to measure the performance. How performance management is measured. That is the next question. So guys, performance management is measured using two attributes: productivity and efficiency. You have to be very productive, which means you have to produce a lot of output. You have to give a lot of output. Second is you have to be very efficient also, which means you have to produce that maximum output using minimum inputs. Now suppose you are sitting for studies for 12 hours, but the final output that you are getting is only for 4 hours. Why? Because you are while you are studying for 12 hours, your mind is somewhere else, or you are scrolling your Instagram or Facebook or WhatsApp during the time you are studying, right? Then in that particular case, the output will be hampered. So yes, you are giving a lot of productivity because you are sitting on the chair for 12 hours. You are giving a lot of productivity. But are you efficient? Answer is no, you're not efficient. You are giving an studying, actually effective studies are only for 4 hours. So you're not efficient. Similarly, if one employee is producing 10 kgs of output, other employee is producing 15 kgs of output, who is more productive? Employee A is producing 10 kgs of output. Employee A is producing 10 kgs of output. Employee B is producing 15 kgs of output. Who is more productive? Of course, employee B is more productive. But let me give you another fact. The input which is employed by A, Mr. A, the input which is employed by Mr. A is 12. After inputting 12 raw material, he is deriving output of 10 finished goods, right? In case of B, B is inputting 22 raw material to get 15 output. B is inputting 22 raw material to get 15 output. So tell me whether Mr. A is efficient or Mr. B is efficient. Of course, Mr. A is more efficient. So although Mr. B is more productive, but who is more efficient? Mr. A is more efficient. So we look at efficiency more than productivity. Productivity is a later thing. Productivity is not as relevant as efficiency. So what do you mean by productivity? Productivity examines the output which is produced. The output which is produced, productivity examines that quantity of work that has been done. What is the quantity of work that has been done? This is productivity. What is efficiency? Efficiency is how much resources are used to produce that particular work. So minimum resources should have been used to produce that particular work. Minimum resources should have been used. This is efficiency. When you use minimum resources, that is efficiency. When you when you see only the output, that is productivity. When output is higher, that is productivity. But when output is higher in minimum input, that is efficiency. So we are focusing more towards efficiency. Guys, look at this diagram. Please look at this diagram. So this is time, this is productivity. Productivity increases over the period of time, right? Productivity increases. But again, we need to reduce time and increase productivity. So over here, productivity increases and time is also increasing. But when we go up, then time is increasing more than productivity. Time is increasing more and productivity is increasing less. So productivity should definitely be an important point, but along with it, we also should see what is the time taken to produce that particular good, or what is the raw material taken to that produce that particular good. That is also important. So this is the difference between efficiency and productivity. Then very important topic, guys, financial performance analysis. Very important from an exam standpoint. How do you assess financial performance of a organization, of a company, of a partnership firm, of an individual proprietorship firm, any business? Okay, how do you assess the financial performance? Guys, the first thing that comes to your mind is return on income, return on investment. Yes, the ratio analysis which you have done in your 12th standard or 11th standard, that ratio analysis is relevant for financial performance analysis. What is the debt equity ratio of the organization? What is the working capital ratio of the organization? Is it that the organization has taken a lot of debt, lot of borrowings it has taken, and it is burdened with a lot of debt? Interest expense is too much for an organization. Is it that ways? Then we will say that performance appraisal is it. Will say that a performance is not good enough when your financial performance is determined by the ratio analysis. Okay, students are saying, please share the notes with us. Just give me 2 minutes. I'll share the notes with all of you. Yes, I forgot to share the notes this time. I'll share the notes with all of you. Just a second. I'm sharing the notes, guys, of the 3 chapters we are going to take up today. Okay. Guys, I've shared the notes on the chat box. Please see the chat box. You can download the notes from here and you can even print them. Please see the chat box. I have given the notes over here, and I'm also giving the link in the description box of this video. Over there also I'm putting the link of these notes. Okay. Yes, guys. So in the description box also I have pasted the link to these notes. Notes are there in the description box also. Yes, on both the places I've saved the notes. Notes are there on your chat box. Notes are there in the description box also. Both the places notes are there. All right. Did you get it? Did you get the notes? Yes, sir. All right. So yes, we are discussing about financial performance analysis. Yes, we do a lot of ratio analysis. We do a lot of comparing the previous year's financials with this year financial to know what is the increase in expenses, what is the increase in revenue, what is the increase in assets. All these things we do in case of financial performance analysis. So financial and performance analysis is one of the most important elements of performance management of any organization or the company. So in this particular analysis, we are going to focus on financial strengths and weaknesses, short-term and long-term growth prospects. Short-term growth prospects or long-term growth prospects are hampered by financial performance analysis. Now, three things which we look at while doing financial performance analysis: balance sheet. What do we see in balance sheet? Assets and liabilities. Secondly, we see income statement. What do we see in income statement? Profit and loss during the year. Income or expenses, revenue and expenses over the year. This is what we see in income statement. Third thing we see is cash flow statement, in which we see receipts and payment, and we ignore the non-cash assets or non-cash liabilities. We ignore them. That is known as cash flow statements. So these three statements are key to our financial analysis. So what do we do in our financial analysis? So we take up some ratios like working capital ratio, financial structure ratio, activity ratio, profitability ratio. And guys, in this particular section, I have given in a table all the ratios which are there. Guys, please remember these ratios very, very carefully from a cost audit perspective as well as SPM perspective. These ratios are very, very important. In cost audit also, these ratios will be used. A question will come in your examination where ratio analysis is required to be done. Over there also, these ratios will be important. And in SPM also, these ratios are very, very important. These are nothing new. These ratios you have already studied in your 11th and 12th standard and in your intermediate also. You have studied these ratio analysis. It is nothing new. It is the same ratio analysis. So things like liquidity ratio, what is the net working capital in an organization, what is the current ratio, what is the asset or liquid ratio. And guys, we also see the ideal ratio, and we compare our ratio with the ideal ratio. Okay, so you have to remember the ideal ratio. So current ratio is current assets over current liabilities, and the ideal ratio is 2 is to 1. 2 is to 1 means 2 times should be the current assets and current liabilities should be 1 time. That is the ideal ratio of current ratio. Then asset ratio or quick ratio, the ideal ratio is 1 is to 1 asset ratio or quick ratio. Inventory turnover ratio, COGS divided by average inventory, cost of goods sold divided by average inventory, is the inventory turnover ratio. Debtor turnover ratio, net credit sales over average debtors, is the debt turnover ratio. So guys, similarly, we have various ratios like debt equity ratio, debt to total capital ratio. There are ideal ratios which are listed over here. You have to read all these formulas, do all these ratios well, along with knowing their ideal ratio wherever it is given. So yes, ratio analysis, please mark over here, is the very, very important analysis from SPM standpoint as well as from cost audit standpoint. Ratio analysis is a very, very, very important. You have to really uh, uh, mug up these ratios very well and understand them. All right, the second way to have financial analysis, okay, second way to have financial analysis is comparative financial analysis. What do you mean by comparative financial analysis? Let me give you an example of comparative financial analysis on a different screen. Okay, I'm giving you this analysis on a different screen. So, okay. So you can see the screen in front of me. Okay. Now, if we talk about balance sheet, If we talk about balance sheet, if I want to analyze my performance in terms of balance sheet, what do I need? What do I need? Guys, I would need current year's number. I would need previous year's number. Then I would want to find the change in terms of previous and current year. And then I will find the percentage change in the current year and the previous year. So for example, fixed assets. Fixed assets in the current year are 100 crores. In the previous year, they were 80 crores. What is the change? The change is 20 crores. Then what will I do? I will divide 20 by 80 to find out the percentage change. The percentage change is 25%. 25% increase has happened in the value of fixed assets as compared to previous year. As compared to previous year, the change is 25%. There's a 25% increase in fixed assets value. So guys, now I understand that fixed assets have increased by 25%. The result is that, guys, I would take care that my sales should have been also increased by 25% or more, or around 25%. If your capitalization increases, then what would be the second impact that you should expect in your profit and loss account or balance sheet? It is increase in sales. Now I will compare this increase with increase in sales. What is the increase in sales? And if there is no increase in sales, then I will question the management. Management, why did you increase these fixed assets when there is no corresponding change in sales? Management might reply that, oh sir, the change you will feel in the next year, because this is the new year when our fixed assets were introduced. Change you will see in next year. That is a valid explanation. So this is how the common size financial statements are made. So let me come back to the original notes. Let me come back to the notes. Comparative financial analysis. So comparative financial analysis is done when financial statements of two or more financial years are compared with each other. So assets, liabilities, as well as income and expenditure of current year is compared with previous year. So both the years' numbers are compared to compute the comparative financial analysis. This is how comparative financial analysis is done. And yes, I have practical questions with respect to comparative financial analysis in my study mat. So you can do one or two practical questions also of this concept. Although this coming in the examination practically is rare, but theoretically you will understand it only when you do a practical question of this particular type, right? Theoretically you will be able to understand it. Next is common size financial analysis. Now this is also an important analysis. This is common size financial analysis. What is common size financial analysis? So guys, now this particular organization, suppose it has fixed assets worth rupees 100 crores. Okay, it also has current assets. Current assets are 20 crores in the current year. Previous year they were 15 crores. Change is 5 crores, and the percentage change is to be calculated. Then there will be miscellaneous, miscellaneous assets, which are the fictitious assets of the company. There'll be a number attached to these also. Then we have certain liquid assets. We have certain liquid assets which are given over here. Now, what is the meaning of common size financial analysis? Now we need to understand the meaning of common size financial analysis. What is the meaning of common size financial analysis? Let me tell you the meaning of common size financial analysis. Let me share the screen with you. All right. So guys, in case of common size financial analysis, previous year figures are not given. Change and change percentage is not given. All these things are not given in case of common size financial analysis. So then what is given in common size financial analysis? Guys, we have another video. We have another line. We have another column. And in this particular column, in case of common size financial analysis, we take fixed assets, suppose, as 100%. We take fixed assets as 100%. Okay. percentage of total assets. We take fixed assets at 100% and we see what is the current assets ratio to fixed assets. So suppose current assets ratio in this particular to fixed asset is 20%. Similarly, if miscellaneous assets are also there, say miscellaneous assets are 5, then the miscellaneous assets as a percentage of fixed asset is 5%. So we do not compare 2 years in this particular statement. We don't compare 2 years. We compare the individual attributes with the major attribute of that particular balance sheet. So for example, in case of profit and loss account, we will compare each of the expenses with sales. What is the percentage of that expense as compared to sales? Expense divided by sales, expense divided by sales. This is the percentage that we try to find out. And then we see internally, not comparing it with previous years, we see internally what is the ratio of, say, personnel expenses to sales, and what has been the ratio in the last year. This is known as the common common size financial analysis. This is the common size financial analysis. Let me take you back to the notes. Okay, so common size financial analysis is also known as component percentage statement or vertical statement. This technique, net revenue, total assets or total liabilities, is taken as 100%. So we will take total assets, total liabilities or net revenue as 100%, and all the other individual items are calculated on the basis of these total assets. So for example, current assets are calculated on the basis of total assets in terms of percentage. Okay. So, similarly, all the expenses will be computed as a percentage of net revenue, right? And then we will compare the performance with similar companies which are there in the industry. So for example, our current asset to fixed asset ratio was 20%. We will compare what is our competitors' current asset to fixed asset ratio. Was the current asset to fixed asset ratio of our competitor company less or more? We'll be able to compare it. Okay, this is known as common size financial analysis. Then guys, last is trend analysis. Trend analysis is very similar, very simple, guys. In this particular method, we compare various years, the performance of various years with our current year. So how is it done? Please show. Let me show it to you. So in case of trend, guys, we have the figures of many years. Okay, this is 2010, 2011, 2012, 2013 and 2014. We have the data for many years. Okay, now we will take 1 year as the base year. Like we'll take fixed asset of 2010 as the base year. Suppose fixed asset of 2010 are 80 crores. That is the base year. 2011 they grow to 89 crores. 2012 they grow to 92 crores. 2013 they grow to 113 crores. 2014 it grows to 210 crores. So this is the growth which happens in the fixed asset over a period of time. Now what we will do, we will analyze the fixed assets of each of the year as compared to the base year. So 89 divide by 80 will compute the percentage. 92 divide by 80 will compute the percentage. 113 divide by 80 will compute the percentage. Then 210 divide by 80, we'll keep 80 as constant and we will take numerator as different years sales, and that numerator will be the deciding factor of our trend. So this is how we'll see the trend. So in what percentage are our fixed assets increasing? And then we will compare these trend with the sales trend. Has the sales also increased in the same ratio? That's the question which we are going to ask ourselves. Okay, so this is the method which is employed. Okay, sir, got it. Okay, so trend analysis. Now we come on to the next topic. Next topic is supply chain management. Guys, a very simple concept. In a business organization, the goods flow in a particular direction, like raw material gets converted into finished goods are then sold in market. This is the flow of goods which happens. This starts from transformation processes that transform raw material into finished goods, like sourcing, procurement, conversion, logistic management, etc. It is an entire flow. How would goods flow? How would raw material come in? How would raw material be processed? And how would raw material be converted into finished goods? And then finished goods finally sold to market. This is known as supply chain management. This is an important element of performance appraisal and performance management of the organization. So this is how it happens. Okay, raw material goes to the producer. Producer produces the finished good, sells it to the distributor. Distributor gives it to the retailer. Retailer gives it to the customer. This is the physical distribution supply chain management. Objective of supply chain management: smooth functioning of every element of production, shipment, and distribution. That is the first aim, first objective of supply chain management. There should be smooth working of production, shipment, and distribution. Second is to minimize costs related to transportation and distribution of goods. Third is integration of suppliers, manufacturers, warehouse, and stores. So all the systems should be integrated. The supplier should be very well connected with manufacturers. Manufacturers should very well be connected with warehouses and stores, so that the entire flow is not damaged, is not halted. Components of supply chain management: first of all, we need to plan. So we need to plan all the resources what we are going to use in our supply chain management. That is the first thing. We need to plan what are the demand and supply of our product and services, according to which we need to strategize what all resources are required. So first is plan. Second is source, to choose the suppliers who deliver the goods and services to us. Where are we going to procure the raw material from? Where are we going to procure the other facilities which are required for manufacturing from? Where are we going to procure it? That is the source which we need to ascertain and take the raw material in. Then make, we need to produce, that is the production. Then deliver, we need to deliver it to the customers. Then if there's any returns which are there from the customers in respect of defectives, then customers should be able to return our products. So what is the return mechanism? So the components of supply chain management are plan, source, make, develop, return. Plan, source, PSMDR. PSMDR. So guys, whenever you are learning some some of the theoretical portions, always make mnemonics. This is a mnemonic. So whenever you think about components of supply chain management, you should think about PSMDR. PSMDR. Okay, so guys. Then next is customer relationship management. I've already told you that, success of a business organization is not only monitored by its profit numbers, by its fixed assets numbers, by its growth numbers, but also monitored by how satisfied is the customer with the product or the business. Satisfaction level of the customer is very, very important. So customer relationship management is a business strategy comprised of process, organizational, and technical change, whereby company seeks to better manage its enterprise around its customers' behavior. So the company has to arrange all its activities around customer behavior. Howsoever customer is willing to react on a particular issue, the company should resolve all its problem at the very first place. Okay. So for example, if I'm going to buy a fridge, okay, so company should take care that I need to deliver the fridge to the home of the customer as well. Company should take care of that fact. So customer needs are the prime goal of any businessman, any activity. That is customer relationship management. We need to maintain a relationship with the customer surrounded with customer behavior. It entails acquiring, developing knowledge about customers and using the information to increase revenue. Objectives of CMR are to understand the customer. First of all, we need to understand the needs of the customer. Needs are required to be understood. Then retain customers through better customer experience. Customer experience should be A1. It should be the best. We need to attract new customer, win new customer, increase profitability, and decrease customer management cost. So we need to increase profitability. We need to acquire new clients and new customers, and decrease the customer management cost. Whatever is the customer management cost, that we need to decrease. That is the objective of CRM. Advantages and benefit of CRM are satisfied customers. The first benefit of CRM is, if CRM is done properly, customer is very much satisfied with the services which it receives. So CRM's first objective or the first target of CRM is to satisfy its customers. If the customers are satisfied, then CRM is successful. Second advantage is product development according to customer needs. So product can be developed according to customer needs if CRM is in place. Guys, what necessarily is CRM? CRM is to identify the customer needs. What does customer actually want? And if we know what does customer actually want, we will knit our product. We will craft our product according to or around the needs of the customers. So that is the advantage of a CRM. A rapid increase in quality of products and services. The quality of product and services rapidly increases if CRM is in place. Ability to sell more products are sold. Optimization of communication cost. Communication cost is reduced if CRM is done fine, because customer putting in grievances again and again will put more load on the company. rather than company beforehand should understand the grievance of the customer and take necessary measures to amend it. So proper selection of marketing tools, trouble free run of business. Marketing tools are to be chosen properly in CRM. Then a trouble-free run of business process. Business process runs trouble-free. Greater number of individual contracts with customers. Individual contracts are more. More time for consumers. Differentiate from competition. Real-time access to information. Everyone has the information access all the time because customer is giving feedback. Okay, and that feedback is available with the management all the time. Communication between marketing and sales and services is there. Increase effect. So guys, any six you can remember. Any six, not all. Okay, sir. Types of CRM. What are the different types of CRM? First is analytical customer CRM. So guys, how do we appraise the customer? How do we know what does customer want? Number one method is customer data is there, and you can you can analyze those data which is there. Customer data is there. You can analyze those data and you can predict the behavior of the customer using the data which you have. So, for example, if a cafe has data of how many customers visit under age of 21 in that cafe, what is the portion of people who are visiting from 17 years to 21 years, what is the proportion of people who are visiting from 22 to 30 years, what is the proportion of people who are visiting from 31 to 44 years. If we have this data, then the management of that particular cafe will easily understand who is the target audience of this cafe, or who are the most of the audience of this cafe, and accordingly the ambience of the cafe can be improved, or the the products can be improved. If we have more participation of older generation, then according to them we need to put the songs. Okay, songs should be old Bollywood songs or remix form of old Bollywood songs. This category of people will enjoy those songs. If we have younger generation more in that particular cafe, then we need some hip hop, we need some Mika Singh, or we need some pop jazz. The first CRM is on the basis of prediction of customer behavior on the basis of customer data. Second is operative customer relationship. So guys, in this particular method, customer is not involved in the CRM process. Customer not involved. Customer is not involved. Their data is taken and it is analyzed on an independent basis. Customer is not involved. Second is when operative customer relationship management happens, when the customer is contacted. When customer is actually contacted, you contact the customer and ask for his feedback, ask for his experience in the cafe and what all changes can he expect in the cafe. If you ask for feedback from the customers, customer support, actual contact with the customer conducted by the front office workers, then that will help us benefit the CRM process. Customer will himself tell us that, oh, we want shikanji in your menu, shikanji, or we want badam milk in your menu. Your menu does not have badam milk, we need badam milk. So these input can be taken by the customer itself. And the third one and the most popular one is collaborative relationship management. Collaborative relationship management, it means that the customer and the cafe will join hands together to develop the desired attributes of the cafe. They will join hands together. So in case of collaborative customer relationship management, we not only ask the the customers to suggest us what should be added, but we also ask the customers to try the new things that we are going to add, and we incorporate the customers into our decision making process. We incorporate the customers. We ask the customers to taste new dishes, to taste new drinks, and tell us whether this should be included in the menu or not. This is the collaborative customer relationship management. It enables all companies along distribution channel as well as departments in a company to work together and share information about the customers. So everyone shares the information about the customers. The goal of collaborative customer relationship management is to maximize the sharing of relevant information acquired by all the departments with a focus on increasing quality of services. So guys, these are the three types of CRM. Analytical CRM, where customer data is given and it is analyzed or it is scrutinized. Second is operative CRM, where the customer is contacted by the front office and he is asked certain questions which he answers to. Third is collaborative, where customer forms an integral part of the decision making process of the CRM process of any organization. Okay, sir, got it. A CRM initiative generally has some of the following risks on an organization. It increases the expectation of senior management. So if CRM is rolled out in an organization, na, management would feel that, oh, after CRM, after doing CRM, now we understand our customer very well. Now the profits will increase multifolds in no span of time. This is the misconception which top management has. Management starts expecting a lot after CRM. However, it takes time to adjust the CRM. It takes time to reap benefit of the CRM. So it will take time to reap the benefits of the CRM. It cannot happen in a split of a second, or in blink of an eye. It cannot happen. Second is increased complexity of managing multiple channels, technologies, customer relationship, and customer definitions. So yes, the entire project becomes a little cumbersome, because we need to manage multiple channels, technologies, customer relationships, etc. Vital and confidential customer information may be transmitted and shared across new networks and systems. So some sensitive customer information, like their age, their preference of height of their hair in case of a saloon. So all these customer private information can be leaked in this process of customer relationship management. Significant changes to organization attitudes, beliefs needs to be done in case of CRM. So this change is very, very difficult. People's attitude should be changed. People's way of looking at CRM should change. That is very, very difficult. And the next one is customer profitability. So this is a kind of customer relationship management which happens in a targeted way. Okay, so there are many customers of an organization. This bar denotes many customers of the organization, and this denotes the profits earned by all those clients. Okay, now we analyze that top 20% of the clients are contributing top 80% of profits of the company. Then our focus should be on these top clients. Naturally, guys, if top 20% clients are contributing to 80% of your profit, then you will focus on what? You will focus on those 20 clients. You will take care of those clients needs. You will take care of those clients wants. So this is known as the customer profitability analysis. We need to know who are our most profitable customers, and those customers should be given utmost benefits. Most benefits should be given to those customers who are our loyal customers, and they are holding 20% or 80% or more revenue of profits. So customer profitability is the profit firm making for serving customer group over a specified period of time. Specifically, difference between revenue earned and cost associated with customer relationship in a specified period. The purpose of customer profit metric is to identify profitability of individual customers separately. We need to understand the profitability of each of the customers separately. What is the profit which is being given by one of the customers? If the profit is given by one of the customers to the maximum of the profit of the company, then of course our focus and attention should be on those customers. And yes, this marks the end of our first chapter, guys. Performance management. So let me ask you, how's the Josh, guys? We are done with the first chapter. How's the Josh? How are you all feeling? Are you feeling bored? Are you feeling energetic to start the new chapter? Should we start the new chapter? How is the Josh in the house? I just want to know that. Yes, we have just completed 1 hour of marathon, and in 1 hour, we have completed the first chapter. How's the Josh? Please write in the chat box. In the chat box, I want to know, how is the Josh? Sharan says Badshah. I don't know for what Sharan says Badshah. How's the Josh, guys? Please write in the chat box. How's the Josh? How is the Josh in all of you? Should we start the next chapter? Super. Hi. Awesome, sir. Dheeraj Kumar. Moshmi. Yes, sir. All right. All right, guys. So let's start the next chapter. And before we start the next chapter, just a 2 minutes break. 2 minutes break before we start the next chapter. All right, yes, guys, we are back with the second chapter of strategic performance management, and the second chapter is performance evaluation and improvement tools. How do you evaluate your performance and how you improve your performance as an organization? That is the key important area of discussion in this particular chapter. How do we evaluate our performance and how do we improve our performance? So, the first method of evaluating our performance is balance scorecard. Balance scorecard is the first way to evaluate our performance. So guys, you can see a girl over here, okay, a child over here, and guys, each mother wants to give a balanced diet to her child. The diet should be balanced. The diet should contain fruits, banana is there, apple is there, grapes is there. Diet should also contain balanced form of vegetables like cauliflower is there, then tomatoes are there, carrots are there, radish is there. Balanced fruit is given to the children, okay? Similarly, an organization's performance is to be balanced also. The organization performance is not only related to profit increment or growth. That is not the only focus of the performance of an organization. The performance of the organization should also focus on how satisfied are the customers, how satisfied are the banks who have lent money to the organization. And that important element of considering everything in your performance is known as balance scorecard. So as a student, you should be good in English, you should be good in Hindi, you should be good in communication skills, you should be good in extracurricular activity, you should be good in sports, right? There should be a balanced growth which is required for you as a student, as a child. Similarly, for a company, for a management, the performance is not only with respect to financials, is not only with respect to profits. Only increment of profit is not the objective, that we have to increase the profit. That is not the only objective. The objective is also to have a balanced growth, and the balanced growth covers these four aspects. So balance scorecard means having a growth in these four aspects. What are the four aspects? First of all, customers should be happy. What is growth in your customers? Are your customers satisfied? Number one. Number two, internal processes should be absolutely perfect without any error. They should be smooth and functioning. So internal processes are the second area of appraisal when you when you appraise your company in a balanced scorecard. Third is the financial perspective. Of course, financial perspective is important. How good is your profit? How good is your current ratio or your debt equity ratio? How good is all those things? That is financial perspective. The last perspective is growth. How well are your employees learning new skills? How much are your employees growing? How as a company you are growing? You know, last year you had only 4 products. This year you have 6 products. Are you growing well? So this is the balance scorecard in which we need to understand that company need not perform well only in one of the attributes. Company should perform well in all the 4 attributes. That is, their customers, internal processes should be good, financial perspective should be good, learning and growth should be good. What are the financial indicators? Profits, operating profit, ROI, economic value added, revenue growth. What are the customer related objectives which we have? Customer should get product of good quality and service. Delivery should be good. Customer should be satisfied. That is the customer perspective. Internal businesses. How should the internal businesses or the key processes should function? Key processes are monitored to ensure outcomes will be satisfactory. The process should be such that outcome is good. The outcome is satisfactory. Innovation becomes one of the major elements of our processes. We should innovate to new processes. That is important. Operation processes, they should be efficient, consistent, timely delivery should happen in case of processes. Last is learning and growth. Our ability of employees should be enhanced. Our employees, if they are working at X level yesterday, then they should work at X plus 2 level today. They should work at X plus 4 level tomorrow. There has to be escalation. There has to be increase in ability of the employees on a continuous basis. Quality of information systems, organization alignment should be there. Organization should also grow. Organization goals should also be achieved, and employee goals should also be achieved. So these are the 4 areas of balance scorecard. How do you develop balance scorecard? How do you use these 4 areas for your betterment? and how do you map your progress in these 4 areas? Okay, number one, identify key outcomes or success objectives of the organization. The first step is to know where do you want to reach. First step is to know where do you want to reach. What are the targets that you need to attain? For example, by the year end, I want to attain gross profit ratio of 38%. That is the target. So first of all, set your targets, and targets should be set in terms of these 4 areas. Targets should be set in terms of these 4 areas. So what are your targets for your customers? So I want an increase in customer of 20% in the current year. Okay, that can be your target. Okay, so what are your targets with respect to customers? What are your targets in respect of internal processes? Targets in respect of financial goals? Targets in respect of learning and growth? What are your targets? This is the question to be asked in balance scorecard. So targets are mapped with balance scorecards. So first step is to identify your key outcomes or your targets. What do you want to achieve? Second is to identify the process that leads to these outcomes. How will I achieve 20% increase in customer base this year? Maybe I have to venture into a new market. I have to capture, I was currently only in Delhi. I want to capture Mumbai. I want to capture Kolkata customers also. So you need to know what are the processes that lead to these outcomes. How do you venture into new markets to increase your market standing? Or if you want to achieve a gross profit ratio of say 38%, how will you increase your revenue, or how will you decrease your expenses? That's the second process, that what do you do to achieve the goals. Third is develop key performance indicators for the processes. Now you need to develop key performance indicators. Key performance indicators means, suppose you are wanting to increase your customer base. Okay, so you have to now calculate the number of customers which you have today, number of customers which you have after 1 month, number of customers which you have after 1 year. So number of customers will form your key performance indicator. Similarly, in case of increasing your gross profit ratio, that is the ultimate target. The key performance indicator will be reduction in expenses. How much percentage expenses have been reduced during the current year? How much increase is there in the revenue? How much contribution has improved during the year? These are the key performance indicators to know whether your overall gross profit has increased or not. So key performance indicators are to be determined. Then develop reliable data capture and measurement system. You should have a management data system where you are able to know what is your current standing in market and what is your future standing in market. That you should know on the basis of that data. So data capture mechanism is very, very important. Develop a mechanism for reporting these data to relevant managers and staff. How to report this data to the relevant manager and staff, that is also required to be seen. Enact improvement plans. Now you need to see how do you improve your performance which you have attained. So these are the steps to develop a balanced scorecard. And remember, all these steps are to be applied on all of these 4 areas. Please don't forget any one area. Please don't forget. All the steps are to be applied on all these 4 areas. Type of information required for balanced scorecard. So, what information do you require to develop a balanced scorecard? So the information which is required is the process of developing activity will make individuals and divisions more aware of their how their work fits with the strategy of the business. So, first of all, when we are developing the activity, when we are developing this balanced scorecard, we first need to get the data from individuals and divisions. We need to get the data from individuals and divisions who are actually performing the work. So the first step of getting information is contact the individual and divisions who are more aware about the business, the strategy of the business, and they can contribute to your data requirements. So the information is to be fetched from the individual and divisions who are actually in the core of the things. Like sales department is on the core of the things of financial perspective. Then the advertisement department is on the core of the thing of the customer side, right? So you develop data from there. Then individual and division should receive regular reports of their performance against balanced scorecard. So on a regular basis, the sales manager should get a detail of what are the sales which have been achieved on a per day basis or on a weekly basis. Senior management should receive regular information on the organization's overall accomplishment. So senior management should get a broad level data, okay, whether the 4 aspects of the balanced scorecard are being achieved or not. So they should get the data. Outside stakeholders may have access to balanced scorecard, help them to have a more good impression of organization's value. So even you can share the balance scorecard data with outside stakeholders. They will know where do you stand. They will know where do you want to reach in future. They will also help you in attaining your goals which are there for you in future. So what are the benefits and limitations of balance scorecard? The benefits of balanced scorecard is that it avoids management reliance on short term financial measures. So sometimes management only focuses on financial activities. If you have a balanced scorecard, then the attention is digressed from financial measures to non financial measures as well. The attention is digressed. Number two, it successfully communicate corporate strategy to functional heads and organization subunits, forcing them to develop their own goals to achieve the corporate mission. So balanced scorecard is, communicated to the functional heads. So functional heads will make sure that they not only run after money, they also run after certain other criteria, certain other things like customer perspective. Customer should be at the core of the strategy. So they develop customer perspective as well. It can assist stakeholders in evaluating the firm. Firm's outlook, firm's performance is measured in terms of balanced scorecard. So an outsider like a shareholder will be able to assess where is the organization moving towards. Is organization able to achieve its goals? That is the benefit. Helps in focusing the whole organization on few key things needed to create breakthrough performance. So the whole organization will focus on these four things, and these four things can increase the performance of the entire organization. That is the benefit. Helps integrate various corporate programs. So corporate programs, initiatives of corporate like re-engineering, customer services will be integrated to these four goals. These four goals will be clearly demarcated. Break down strategic measures towards lower level and managers. So managers and strategic level people, execution level people are also aware about the goals of the organization. Clarifying and updating budgets. Budgets will be clarified. Identifying aligning strategic initiatives. The initiatives will be focused on these four areas if we communicate these four areas to our strategic partners. Helps conduct periodic performance of reviews. Then, what are the limitations of a balanced scorecard? There is no clear relationship between balanced scorecard and shareholders' value. So, guys, shareholders' value is always increased by financial indicators. However, balanced scorecard has three more indicators. So, it is not necessary that balanced scorecard success is always visible in terms of shareholders' value. Sometimes customers are very, very satisfied, but profit levels are low. So, shareholders' value is low, but customer is very, very satisfied. So, it's a positive thing. So it is not necessary that balance scorecard gets converted into shareholders' value. Shareholders will get benefit out of it. Shareholders will get profit out of it. It is not necessary because balance scorecard is not only about profits, not only about financial things. Then does not lead to single aggregate summary of control. So, there are four factors in balance scorecard. So four factors are required to be seen individually. There's no single factor where we can see that, okay, this is the factor, you need to control it. There are four factors, and that too very different four factors. This is a limitation of balanced scorecard. The measures give conflicting signals and confuse management. So sometimes what happens is 1, 2, 3, 4. One factor has worked very well. Second one has not worked so well. Third one has performed very well. Fourth has not performed very well. So on an overall basis, the balanced scorecard looks a little confusing because there are four different things which we are seeing. And all those four different things might give you four different results. Therefore, balanced scorecard is a little confusing sometimes. It involves substantial shift in corporate culture. Corporate culture is shifting in case of balanced scorecard, because earlier it was always felt that financials are the key. Profit is the aim of the organization. But no, now with advent of balanced scorecard, we have seen that financial performance is just one of the four criteria of success. So financial performance is not the end of the game. Okay, sir. Next is benchmarking. What do you mean by benchmarking? Guys, benchmarking means setting targets. We all benchmark in our daily lives. Benchmark in the sense, many of you might be doing that, after examination, you might do that. How many footsteps do we walk in a particular day? 10,000 footsteps we need to complete daily on a particular day. This is the monitoring which we do using those smart bands, right? And we set a target for ourselves that every day we will do 10,000 footsteps. This is known as benchmarking. We should have targets before ourselves. We should have targets. Your target is clearing CMA final with good marks. That is your benchmark. So benchmarking means setting targets for corporate in terms of financials, in terms of everything, guys, in terms of everything, the benchmark is required to be done. So I've given you an example in the class. We have discussed this example. So we always benchmark our mobile phones. Whenever we are selecting mobile phones, we compare mobile phones with each other. We benchmark mobile phones. So display of Samsung Galaxy M31 is 6.4, iPhone is 4.70, OnePlus 7 Pro 6.67 inches, Google Pixel 6 inches. So we benchmark our requirement of the screen size. We see that screen size of Samsung Galaxy M31 is the good one. OnePlus 7 Pro is very good screen size is there, right? So we benchmark in this particular way. Rear camera is benchmarked, front camera is benchmarked. This is how benchmarking happens as compared to your competitors. So types of benchmarking, on what all areas do we do benchmarking? That is what we are going to see now. First is product benchmarking or reverse engineering. Every organization buy its rival's product to find out the features and performance, etc., as compared with its own products. So first of all, we need to see what are our rivals' product and what are they making better as compared to our product, and we try to compare it and we try to compete with it. So first is product benchmarking. Our product should be of equal quality and equal features as compared to our competitors. Then competitive benchmarking. This has moved beyond product orientation. This also includes the processes. Okay, includes marketing, finance, HR, R&D department. So competitive benchmarking means we don't only compare our product with our competitors' product, but we also compare our processes with our competitors' processes. So what is the advertising process of our competitor? We try to match up with him. What is the finance process of our competitor? We try to match up with him. So, this is a very common practice that, finance department head of one organization switches to another organization, switches to the competitor organization. This happens quite often because competitor wants to know what is that particular organization doing in terms of their finances, what is the steps that they are doing in terms of their finances. The other organization wants to know. So competitive benchmarking is even more high in scope than product benchmarking. In product benchmarking, we are only comparing products. In competitive benchmarking, we are comparing products as well as processes. Processes are also getting uh, benchmarked. Then process benchmarking, activity of measuring performance functionality of business processes of organization with excellent similar business processes. So guys, competitive benchmarking was comparing the functions, and process benchmarking is comparing the processes with the best in town. So both of them are similar. Both of them are similar. Competitive benchmarking and process benchmarking, in which we are comparing our processes with the competitors' processes. Internal benchmarking. Now, in this particular benchmarking, we are not comparing performance of our business with some other business. We are comparing performance of our, one of the businesses with other businesses. We are comparing that. So we are comparing our, maybe our refrigeration business HR department with our cooling division business HR department. Refrigeration versus AC department, we are comparing HR of both of them. HR of refrigeration department is doing very well, and the HR of AC department is not doing that well. So this is known as internal benchmarking. Strategic benchmarking. Strategic benchmarking is a benchmarking which is operational benchmarking, a higher version of operational benchmarking. And in this, we are actually benchmarking our core competencies, are all strategies which the business is doing, and we are comparing it with the competitors. So the strategy which the competitors are adopting, like, price skimming strategy. Our competitor has applied price skimming strategy. So we are going to also adopt price skimming strategy in that particular case. So we are developing the benchmark. Global benchmarking, when we are benchmarking not only within Indian competitors but also from outside competitors, we are benchmarking. So this very much happens in quick SR, quick QSR. What is quick SR? What is QSR? QSR is quick restaurant services. So where something is served very quickly, like McDonald's, and the table turnout is very fast. So in case of QSRs, global benchmarking is done. For example, McDonald's, which is present in India, it will benchmark its quality, its ambience, its products with the McDonald's which is located in United States of America. This is the global benchmarking. So global benchmarking is also done. Process of benchmarking. How do you benchmark your product with your competitor's product? First of all, we plan, that is, we determine the benchmark which we have set for ourselves. We plan, we determine the benchmark. What is our benchmark? What is our standard? Whether it is Indian standard or it is outside standard. Collection of data and information. We then collect the information to know what are the requirements to reach to that benchmark. Analysis of findings. We find the gap between our current performance and how to better the performance. We analyze the difference between our current performance and the future performance which we want to attain. So analysis of finding. Then we have the recommendations, how to bridge gap between our current performance and our benchmarked performance, our goal. We need to compare and recommend the improvement strategies. Then we monitor our success and we review our success occasionally. That are we able to attain the global standards that we have always tried to attain? Are we attaining the global standards? That is what we are going to monitor and review. Prerequisites of benchmarking. What are the requirements in benchmarking? How do we ensure that benchmarking is a success? Commitment is required from senior management that they will support in continuous improvement of benchmarking, because sometimes senior management invest money in benchmarking and then they do not invest money in further improvement of the products. So commitment of senior manager is required, that till the last stage of benchmarking their financial support will be there, their recommendation support will be there. Then clarity of objective. We should be clear about our objective. Where do we want to go? What do we want to achieve? This should be very, very clear. In terms of benchmark, we should have a clear picture of our firm's performance. Then appropriate scope. What is the scope of work? What are we going to do to achieve this firm's performance? That is very, very critical. What are the resources which are required? What are the time which is available? All these things needs to be seen while computing our firm's performance. Then what are the resources which are required? This to be seen. Skills which are required for benchmarking. And then communication. We need to communicate our benchmarks to the stakeholders, to our staff, to everyone who will support us in achieving the benchmarks which we have set for ourselves. We need to communicate the benchmarks to our team. Just like, guys, you communicate your benchmark of completing CMA final in June 2022 attempt to your parents, to your cousins, to your colleagues, to your brothers and sisters. You tell them that I'm not attending your birthday party. Why? Because I have to complete my studies and I have to become a CMA. You tell your cousin that I'm not attending your marriage. Why? Because I have to complete my CMA. I'm studying. I don't want to waste time. You tell your Mosaji, Mosiji, Mamaji, Mamiji that, I cannot meet you quite often because my exams are round the corner. You tell that. So, benchmarking needs communication to the entire stakeholders community. You tell everyone that you are following this particular goal and therefore please do not disturb. Difficulties in implementation of benchmarking. It is definitely a time consuming process. First we set the benchmark, then we work towards the benchmark. It's a time consuming process. Sometimes management do not support in terms of money. Okay, they don't even get themselves directly involved in the benchmarking process. So benchmarking becomes difficult. Employees are resisting change. There's a inherent limitation in employees, that all the employees resist change. They don't like changes. So there's a resistance in employees with respect to benchmarking. Paper goals. Sometimes the other things, the other requirements take over the goals of benchmarking, and the goals of benchmarking are at a back seat. They are not done effectively. So paper goals are there. Then copy paste attitude. The benchmarking which is available in market, you generally copy paste that benchmarking in your company as well, without realizing that your company is different from other companies. This affects the benchmarking a lot. This approach condemns benchmarking to fail, leading to failure of benchmarking goals. Please understand that every company is individual. You cannot adopt someone else's benchmark. So if Reliance Industries Limited is doing very well in petroleum business, Tata's cannot say that, oh, I will attain the same benchmark as Reliance Industries Limited, because Tata's are not that good in oil business. Tata's are more good in hospitality business. They are more good in fine cloth business. So that is how the benchmarking is not copy paste. It is not copy paste. Then what do you mean by bench trending? Bench trending is continuous monitoring of performance with the selected group of benchmarks. When you continuously benchmark your activities over a period of time, and then you compare your benchmark over a period of time, and you develop a trend, that is known as bench trending. What has been your success of benchmarking in last several years? That is your bench trending. So bench trending is continuous monitoring of performance. That is bench trending. Then comes a very, very important topic of our syllabus, guys, management information system. Guys, management information system is a way to provide relevant information at the right time in the right format to all the users of the organization for effective decision making. So to decide upon the business, to decide upon the future, um, uh, to to decide upon the future. अच्छा, शरण कह रही है लोगों ने इनवाइट ही करना छोड़ दिया क्योंकि मैं पूरे दिन तो पढ़ती रहती हूँ. वेरी गुड शरण, कोई बात नहीं शरण, जब तुम CMA शरण बन जाओगी ना, तब वो लोग जो अभी जिन्होंने तुम्हें इनवाइट करना छोड़ दिया ना, वो तुम्हारे घर आ आके तुम्हें स्पेशली लेके जाएंगे और तुम्हारी अवेलेबिलिटी पूछ कर तुम्हारा अपना प्रोग्राम डिसाइड करेंगे. सो घबराना मत अगर लोगों ने पूछना छोड़ दिया तो. Management information system. What is management information system? To provide right information at the right time, at the right format to the relevant decision makers. That is the management information system. Or ye management information system is given in various ways, guys. There's various tools like, bar coding and decoding is there for inventory management. Bar codes are there for inventory. What inventory is getting diluted, what inventory new is coming, all this is given in barcodes. Then programmable logic controller. Now these are also techniques of effective MIS. You will maintain a database of what inventories are getting sold, what inventories are getting purchased. So all these things will help you in maintaining a database of the inventories or fixed assets or anything. Like, guys, SAP, Oracle, the ERPs which are there, these are the databases. So if management wants to know what is the gross profit in the current year, they can quickly get this information from SAP or Oracle. Financial and non-financial data is there on SAP or Oracle. So these are the modes of collecting data in case of MIS, and data is required to make decisions. So what decisions would MIS make? So guys, top level management, you will use MIS for generate accurate, reliable, timely, comprehensive information to top management. So MIS will give reliable information to top management with respect to anything. Through simulation models, MIS will assist top management in planning their work activities like developing financial models. Financial models are developed on the basis of simulations, on the basis of data. Top management will need data for simulations. Top management will need data for test impact of ideas, strategies formulated on future profitability. Whatever new has been introduced, whether that is successful or not, how would management know about it? By seeing the data of profits. If profits have increased, strategy has been successful. If profits are not increased, strategy has not been successful. Then potential impact of computers would be more in the area of planning and decision making. So computers will form an important area of MIS. Of course, without computers, MIS is not imaginable in today's world. Then how would middle level management be, getting information from MIS? At this level, decisions will be programmed and thus will be made by the computer, like inventory control system. So the middle level management will be more bothered about the functions of the organization. Okay, they will not be involved in strategic decision making like top level management. So what will middle level management do? They will look at purchases, they will look at issue, they will look at balances which are there, they will look at when to reorder the inventory, etc., etc. And what will the supervisory level do? At the level of execution level, they will be concerned with the day-to-day decisions. Day-to-day routine decisions will be seen. They will control the time. Comprehensive suitable reports are there at the managers to control the functions and operations. Then with help of computers, the future all the controls will be employed by the supervisory level. So supervisory level will also benefit from MIS in terms of their workings. Okay, then what are the objectives of MIS? To provide timely and accurate information, to highlight critical factors in operations of business, to develop systematic and regular process for communication. How do the organizations within organization, how do you communicate? Communication will be seamless in case of MIS because what inventory has been purchased during the current day, that will automatically reach the production manager easily. Production manager doesn't need to call the purchase manager to know what is the inventory which has been purchased. It will be fed in the system and the production manager will take out the details from the system. So communication will be very, very easy. Then decision making will become smooth. Services to the customers will be given in a more efficient manner. Competitive advantage will be there in case of MIS. Then provide information to support business planning of future. All right, sir. So these are the benefits of OLAP. This is the benefit of MIS. So guys, after MIS, there are more advanced technologies for saving data. There are databases which are created, and there are more advanced technologies whereby data is not only created, but it is also analyzed. So MIS is more concerned with storing the data and retrieving the data. But these techniques like OLAP, they not only store and retrieve the data, but they also process the data. They will give you the reports which you desire. OLAP will do that. So OLAP is a very good tool to analyze the data through fast, consistent, interactive access to wide variety of possible views of information. It's a multi-dimensional database which interact with multiple perspectives. So OLAP tools are the tools which are used for data processing along with data storage. They also process the data along with data storage. They also process the data. Okay, sir. So OLAP server is a high-capacity multi-user data manipulation engine specifically designed to support the multi-dimensional data structure. So this is the data structure. OLAP supports this data structure. It can store multi-dimensional data easily. Now there are different types of OLAP. There are multi-dimensional OLAP. There is a relationship OLAP. There is a hybrid OLAP. There are other OLAPs. So what are multi-dimensional OLAP? Multi-dimensional OLAP means these OLAPs are online analytical processes. Full form is online analytical processes, and they can have data from multiple sources. Multiple type of data can be stored in OLAPs. Multi-dimensional data can be stored in OLAPs. OLAPs can have data of various kinds. Their multi-dimensional data can be stored. Relational OLAP, it works directly with the OLAP. The database and dimensions tables are stored in relation tables. New tables are created to hold aggregate information. So, relationship OLAP also connects data of two types. It also connects data. So for example, details of employees are saved in one of the sections, and the details of sales is also saved in another section. So to connect these two databases, we will see how many employees have sold how much quantity of product. They can be connected together. So relational OLAP connects two set of datas. It connects two set of datas. That is relation OLAP. Then hybrid OLAP can be used as a relationship OLAP. It can be used as a multi-dimensional OLAP. It can be used as any kind of OLAPs. It can be used. So hybrid OLAP means where multiple OLAPs are combined. The features of multiple OLAPs are combined together. Other OLAPs are OLAP, MOLAP, desktop OLAP. So these are all OLAPs. These are all analytical procedures which help in data processing in various areas. Like in mobile, it's mobile OLAP, desktop OLAP. Net, what is it? Net, it is, guys, that we need to analyze data. We need to churn out the data. That churning is very much important. For example, I have an app in my mobile which tells me how many hours have I spent in each of the apps. How many hours have I spent on each of the apps? So this is an example of MOLAP. This is an example of MOLAP. I have a mobile OLAP which is analyzing my use of my mobile phone in various apps. So in WhatsApp, these many hours are used. In Facebook, these many hours are used. In Instagram, these many hours are used. On text messages, these many hours are used. This is the MOLAP. So there's a system in my phone which is not only saving data, but also churning out data, processing data. Saving data example is the phone book that I have, phone directory. That is not churning data. It is just saving data and retrieving data. Whenever I want to call someone, I will tell the phone that please call this person. It will call that particular person. So it's only storing data and retrieving data. However, in case of my app, which is even processing data, it is showing me how many hours have I spent on each of the apps. On a percentage basis, it is showing me that is a OLAP, which is also analyzing data for me. It is not only showing the hours which are spent by me, but it is also showing the percentage of consumption of battery which is there, consumption of time which is there. All those things are done by OLAP. Okay, sir, got it. Next tool of productivity and profitability improvement is MRP1, MRP2, and ERP. Now, the only objective is to improve the productivity and profitability of an organization. Three tools are MRP1, MRP2, and ERP. MRP1 is the oldest tool. The name is Material Requirement Planning. MRP1 is Material Requirement Planning. It was introduced in 1970. Then 1980, Manufacturing Resource Planning. 1980, Manufacturing Resource Planning. 1990, ERP. ERP is the latest version. This is the oldest version. This is the second version. So the aim of these tools are to give a consolidated database to the management to store all its production related information. Like material requirement planning is the tool which gives the businessman an idea about what inventory is lying in the warehouse, how much is required, how much should be bought, how much is there on the production line. That's the material requirement planning. So MRP1 is a technique which aims to ensure that material resources like raw material, bought in components, in-house subassembles are made available just before they are needed. We should not have shortfall of any of the material. That is the aim of MRP1. We should not have shortfall of any of the materials. That is the aim of MRP1. So MRP1, it determines for final product what should be what should be produced and at what time should it be produced. MRP tells us when should the final good be produced. It also tells us the situation of sub assemblies which are there. Bill of material is updated or not. What are the material requirements on bill of material? It also calculates inventories, work in progress, batch size, etc. So yes, these are the uses of MRP. Okay. So guys, features are also very simple of MRP. Yes, data requirement of MRP is the next thing that we need to discuss. An important aspect. What are the data requirements for MRP? We need to plan our material requirement in such a way that material is never in a shortfall. So the data requirement is what is the production schedule of our production? How many how many finished goods are produced on day one? How many finished goods are produced on day two? So the book PDF is shared on the description of the link which is given below the book. In the description section, a link is given. There, the book is there. So we need the production schedule. We need the bill of material. So while making one finished goods, what quantity of raw material 1 is required, what quantity of raw material 2 is required, what quantity of raw material 3 is required. That is the bill of material which is required by us. Then inventory file is required. So how much inventory is there for each of these raw material for which the finished goods is produced. Routing file is required. What is the sequence of operations required to manufacture components? That is required. Then master parts file contains information about production time of sub-assemblies and component produced internally, lead time of externally procured items. So the master part files will tell us that what components are produced and how much time will it require for the raw material to purchase and to get to the warehouse. These are the things which are to be ascertained in master parts file. Method of operation of MRP. This is very, very simple, guys. Okay, this is not very, very difficult. Benefits of MRP is a repeat. Now we directly come on to MRP2. MRP2 is the abridged version or a better version of material resource planning. So in MRP1, the only focus was on material. In MRP1, the only focus was on material, raw material, inventory, finished goods, BOM. The focus was on material. However, in case of MRP2, the focus was on the entire manufacturing resource planning. So apart from the material, what are the resources that are required in manufacturing? Of course, we require people. We require tools and equipments. We require machinery. Apart from raw material, we require several other things. So MRP2 was a broader concept, a wider concept, whereby not only the material requirement was ascertained, but the entire infrastructure or entire requirements which are there for manufacturing process as a whole was to be ascertained. So this is the second part, which is manufacturing resource planning. It utilizes software application for coordinating manufacturing processes from product planning, part purchasing, inventory control to product distribution. Everything is there in manufacturing planning. So MRP2 will include a production interface, which will include raw material, okay, equipments which are required to produce, machinery which is required to produce, human resource which is required to produce. This is all included in production interface. Then marketing interface, which means whatever has been produced, how will it be sold? And the third one is accounting interface. How will the produce, whatever is being produced and sold, how will it be recorded in the books of accounts? How will it be recorded in the books of accounts, in the accounts? So MRP2 contained three elements. MRP1 contained only one element, material. They only focused on material. MRP2 contained focus on production, marketing, and accounting. MRP2 is wider in scope as compared to MRP1 because the functions which are there are much more higher. So MRP2 systems will first demand forecast will be there, then production planning will be done, resource planning will be done, how much resource is required for producing a particular good. Rough cut capacity planning will be done. What is the capacity? What is the master production schedule? We'll ascertain it. Bill of material requirement. So all those things are there in MRP2. It is much wider in scope. Apart from material, we are also seeing other things which are required in manufacturing process. That is MRP2. And yes, guys, MRP1, MRP2 are things of past now. Now we have the much coveted and the much amazing ERPs. Guys, forget about only manufacturing process. ERPs integrate HR department, production department, manufacturing department, marketing department, finance department, sales department, planning department. All the departments are integrated by MRP. So MRP1 focused only on material. MRP2 focused only on finance, marketing, and production. ERP focuses on the entire organization. It knits the entire organization in one thread. This is the best part of ERP. And ERPs are the most successful thing in today's world. SAP, Oracle, these are the most successful thing in today's world. They provide integrated business software modules to support functional units of enterprise like order fulfillment, material procurement, balance sheet preparation, etc., and attempts to integrate various functions of an enterprise involved in execution of these processes. So various elements of the enterprise are being integrated for execution of the processes in case of ERP. ERP has the ability of fulfillment of needs of specific departments, functions. So whatever needs are there for a specific department, they are fulfilled by ERP. ERP will take care of all the requirements of a particular department. So for example, if HR department is hiring some people, ERP would have information on who are being hired, who are being inducted in the organization. ERP will have that information also. So ERP is very, very flexible. It integrates all the functions of the management. All the functions of the organization is integrated in ERP. So ERP is very, very flexible. It's modular and open, which means its interface can be attached or detached without affecting rest of the modules. It has various modules like finance module, like production module, like marketing module. It has various modules. So you can use any of the modules which you require and exclude any of the module which you don't require. It's comprehensive, which means it supports all the organization functions. It supports all the organization functions. So it is comprehensive. It supports all the organization functions and is suitable for wide range of business organizations. Then it is beyond the company. It is not only confined to the company, but it can also integrate the debtors of the company, the creditors of the company. It can create online, a connect between the company and the debtors of the company. So debtors can see their outstanding balance in the ERP of the company. That is the beauty of the ERP. It's beyond the company. Even the debtors can enter into your financial module only in the debtors section to see their dues in the company. That is the benefit of ERP. It goes beyond the company. Best business practice. It is the best business practice in town, and it is the most effective business practice in town. Integration. It integrates functions like manufacturing, procurement, sales, distribution. Everything is integrated in ERP. Everything is put together in ERP. Then it has add-ons also. Many separate things are also there. What are the benefits of ERP? It lowers the cost. It reduces paper and postage consumption. It improves productivity of process. It leads to inventory reduction. Why? Because now no huge amount of inventory should be stored. ERP will tell you whenever the inventory is below the EOQ, you can order the ERP inventory then. So inventory cost is reduced. Lead time is reduced. So the time of retrieving data is very much reduced. The time of connecting between two departments is reduced. Stock obsolescence is reduced. So there are many benefits, tangible and intangible benefits of the ERP. Now this is very, very important, guys. Sometimes ERP fails. What are the reasons of failure of ERP? What are the reasons why ERP fails? Lack of effective project management. ERP is such a huge project that if each and every department of the organization doesn't work relentlessly for this execution, this will not be successful. So ERP is to be implemented widely across the organization. Lack of effective project management is the first reason of failure of ERP. Inability to resolve issues, making decision on a timely manner. So ERP requires decision to be made on a timely manner, a quick manner. Resources not available when needed. Perceived or real lack of executive support. Sometimes top management support is not there in implementing ERP. They find it as a burden. They find it as a challenge. So that is why it fails. Software failed to means business needs. Sometimes the software is not customized to meet the business. Then underestimate level of change of management. So the change which is required by the management, that we are not able to comprehend, because there's a lot of change which is required while implementing SAP. Improper communication, insufficient end user training. Training is not given to the user. Communication is not done about the ERP to the junior levels or senior levels. Future gap analysis, etc., etc. So these are the certain disadvantages of using ERP. Now we move on to the next topic, which is total productivity management. Now we have seen how to manage our data through MIS, through ERP, through MRP. We manage our data. Now let's see, how do you manage your productivity? How do you manage that your productivity is up to the mark? Now productivity and quality. Productivity and quality are two things that we need to manage well. Our productivity should be good and our quality of goods should also be good. So TPM is the management process developed for improvement in productivity by making processes more reliable and less wasteful. So it is the management process for developing the productivity. Productivity is improved in TPM. Productivity is improved and the processes are less wasteful. Objective of TPM is to maintain the plant and equipment in good condition without interfering with daily processes. That is the fundamental of TPM. So guys, this is just for your information. Okay. There are 8 things which TPM requires. So if you want to control your productivity, you have to control your maintenance first of all. There are 3 kinds of maintenance that you need to control in your machine. Okay. Because productivity is directly related to your machine. If your machine is in a good condition, your productivity will be well. So your maintenance should be of 3 types. Autonomous maintenance, which arises when it needs. Planned maintenance, we anyways maintain our machinery even when it is working in the perfect condition. Then quality maintenance, sometimes to improve the quality we maintain the machine even when maintenance is not required, but we maintain it, we do some repair maintenance in it so that the quality is increased. So these are the first 3 legs of productivity management. Then focus improvement is required. We need to focus on which area do we need to improve. Early equipment maintenance, you can maintain the equipment early even when the due date has not come. Training education is an important part of productivity improvement. Productivity will increase only if the employees are trained on how to use the machinery. Safety, health and issues are there. And office TPM is very, very important. Office TPM means how to maintain productivity in office, how to not waste the resources in office. That is very, very important in case of total productivity management. Total productivity is to be managed by the company. The entire office should be. Example of ERP. Example of ERP is SAP or Oracle. So what is there in Oracle? It's a software which not only has your financial information but also has your HR related information. How many employees are there in the company as a whole? What is their salary? It also has information on inventory. What inventory has been purchased during the month? So earlier there were separate softwares to control all these things. ERP will ensure that in one software we control all the things. Like finance module is there, like production module is there, like HR module is there. All the things are controlled by one software, which is ERP. And the example of ERP is SAP or Oracle. These are 2 famous ERPs of the world. All right, sir. So what are the benefits of productivity management? So the benefits of productive management is a set of new management goals will be developed by the management. Management will look at productivity in a very new way. So new goals will be developed. Team bonding and better accountability will be there. Improved quality, total cost competitiveness will be there. Productivity is there. So these are the various benefits of total productivity management. Okay, sir. Yes, now we move on to a very, very important aspect, guys, total quality management. And please note that a practical question from this particular aspect came in December 2021. In December 2021, a practical question from this particular topic came. Total quality management. How to manage quality of a particular organization. a practical question came. So I have done practical questions in my class for this particular topic. You also must do it. There's practical question in your book, study mat of the institute as well. Please do that practical question, because this topic is not only relevant from a theory standpoint, but also from a practical standpoint. Now, what do you mean by quality? Guys, quality means to eliminate the loss which results from defective units. Defective units should not give us loss. Defective units should be minimized, because defective units are the reasons for loss. So defective units should be minimized. So total quality management is directly related to defective units. The units which are defective, those defective units should be reduced to increase the quality. Not only designed to build quality in the product, but also restrict the defectives and inspect and rectify them. Principle of TQMR. First of all, customer focus. We need to focus on what do customer require, what level of quality is required by the customer. Sometimes customer doesn't require high quality, but it requires a medium level quality at a reasonable price. So the focus will be on customers. What quality of goods do they require? Managerial leadership is definitely required in case of TQM, because management will only formulate the strategic plan, which will ensure that quality is a key ingredient of our plan. So the strategic plan should contain quality as a core component in it. Belief in continuous improvement. So, total quality management will only happen when continuously you thrive to have higher quality continuously. So continual improvement drives an organization to be both analytic and creative in a constant base. So continuous improvement is required. So what are the steps in TQM? What are the things that we do in TQM? First of all, we identify the customers or customer groups. We should identify our major customers, and we need to also analyze their identification. So we need to identify the customers, the main customers, and we need to take decision on which customer issues are more critical. We need to analyze the critical customer issues with respect to quality. Then we need to identify the customer expectation. What is the expectation of our customer with respect to quality? Then the identification of customer decision making requirement and product utility. We identify the need of the customer and follow their suggestions. Whatever suggestions they make, we need to follow those suggestions. So customer decision making is required. Identification of perceived problems in decision making process. So what are the problems which a customer feels that are there? So shortcomings are identified, problem areas are identified in providing the quality product which customer requires. Comparing the organizations and benchmarks. So we will compare our performance, our quality with other firms quality and other firms benchmark. We'll take some feedback from the customer. Whatever problems are there, were they resolved now? Identification of improvement and opportunity. We will identify what is the improvement opportunity which is there. What improvement is required in our product. Whatever is the improvement which is required, we will give that particular improvement to the customer. And the improvement will be given using this praise. Okay. This is a 6-step process. Problem identification, ranking, analysis, innovation, solution, evaluation. So first we'll identify the problem, then we will rank the problem based on which problem is high, which problem is low. Then we'll analyze the problem, we'll innovate some ways to reduce the problem. Finally, we'll provide the solution to the customer, and we'll evaluate whether the solution worked well or not. This is the praise level. So these are the processes which are steps which are there in TQM. So there are certain other quality tools, certain other ways to improve the quality of our products or our processes. Number one is statistical quality control. So guys, statistics is one tool which is used a lot for quality control. Okay, statistics you have already studied in your junior classes. Statistical tools are used to monitor and maintain the quality of the product. Please underline whatever I'm underlining in my notes. So to monitor and maintain quality of the product, statistical tools may be used. So statistical techniques may be employed to determine whether the process is functioning as desired or not. So guys, statistical tools like decision making, we had done in our OM in your intermediate. Okay, decision tree, decision making, or some sort of flow charts which are used for decision problem solving. They are the statistical tool. Then acceptance sampling. We always take some samples out of the total items, and we test them whether they are quality approved or not, and the rejection should be at the least. The rejections which are there should be at the least. So acceptance sampling is done while analyzing the quality of a particular product. Then statistical process control. Example of OLAP. Just like ERP is there, ERP, integrates all the functions of the organization, like HR, like finance, like production, like marketing, like distribution. ERP is a conglomeration of all the functions, right? OLAP is not a function of all the functions. It is not a accumulation of all the functions. It just focuses on a software which is used to process data. I gave you two examples. Okay, in my mobile phone there are two things. Number one, my phone book. My phone book just allows me to save data and retrieve data whenever I require it. Okay, so that is not OLAP because it is not analytically processing the data. It is just a method of feeding the data and retrieving the data. It is not OLAP. What is OLAP? OLAP is that in my mobile phone, I've got a tool which will tell me what percentage of time, first of all, how much time have I spent in the phone, and what percentage of time has been spent on which tool, which app. Was it a social media app? What is a health app? Was it a communication app? So this is the analysis which is done by OLAP. So there are two kind of things. One is MIS. MIS will only save data and retrieve data. That is the only purpose of MIS. Just like our mobile phone books. Phone books will save data, will save names of my contacts, and will retrieve name whenever I require. Okay, that is MIS. OLAP is they will not only save data and retrieve data, but also process data for me. They will churn out data for me. That is known as OLAP. Analytical process. It's an analytical process. I hope you understood. Lavanya Paruchuri. All right. So yes, statistical measure, statistical process control, statistical process control. A very important statistical process control is Six Sigma technique. Okay, Sigma technique. There are control limits in Sigma technique. Okay, there are control limits in Sigma technique. Standard deviation is there. So guys, in 2019, a practical question from this particular aspect came in the examination. This is a practical formula which is applied in your practical questions. So in 2019, there was a practical, 2019 or 2018, there was a practical question which came from this particular formula. But nothing to worry, guys. I have done that question in my class. You should also do that one question with you. But I don't think that is going to repeat. I don't think a practical question from this particular aspect can come again, because that was once that it came. But you need not remember this entire formula because it is not that important. But yes, one question, if you can, it's a very, very easy question. Just apply this formula and compute the standard deviation. It's a very, very easy formula which you can easily learn. Then is the Six Sigma methodology, guys. Six Sigma methodology ensures that your output is perfect. There is no defect, zero defect. Six Sigma technology aims at zero defect. There should not be any defect in any of the product. Although it is very, very difficult to achieve zero defect. It is not possible that you are doing some production and there is no defect. But Six Sigma technology has proved that it can be reduced to a very, very bare minimum level, like 1% or 0.1% or 0.6%. The defectives can be reduced to very, very zero or negligible levels. This has been proved by Six Sigma technology. Like, do you see this runway? This is the width of the landing strip. Okay. If the pilot always lands within half the landing strip width, we can say that pilot has Six Sigma capability. So the aim is that on this half of the strip, the pilot should land. Pilot should not use the broader width. Pilot should always land on this particular area. If the pilot always lands on this area, then we will say that he has Six Sigma capabilities, that he's not showing any defect. He's not showing any he's not showing any defect, any problem. So Six Sigma means you do whatever you do it with perfection. You do it with absolute accuracy. This is the concept of Six Sigma technology. Okay, sir, got it. Yes, Six Sigma methodology has got certain methods within it. DMAIC, DMADV. Both were inspired by W. Edwards Demings. Okay. So DMAC and DMADV. So DMAC means define, measure, analyze, improve, control. This is the 5-step process which has been prescribed by Six Sigma to control your defects to a very minimal level. Number one is define the process. Whatever process improvement you want to do, define that process improvement. You measure the current process and collect the relevant data for future comparison. So you collect whatever output you are generating today. So you measure the current process, you analyze the relationship and causality of factors, you analyze the difference between the current performance and the future performance, you improve and optimize the process, whatever process you are improving and optimizing, control the variances which are there in future. So whatever you had decided as a goal for you and versus whatever is the actual which has been earned, you compare both of them, and whatever is the difference, you control the variances. Please see this diagram. So you identify opportunity, you identify measure the output that you want to obtain, you analyze the current situation and future situation, you improve the current situation, and you finally control the development which you have made. So DMAIC is converted into an equation. Output is a function of input. Output is a function of input. The next Six Sigma technology is a little detailed. Define, measure, identify, analyze, design, verify. This is a detailed method of Six Sigma technology. So define the goal, measure and identify the critical two qualities areas, analyze to develop and design the alternatives. Final phase, the team validates and verify the design acceptable to all stakeholders. Again, guys, same principle, guys, that we need to have a streamlined way of reducing our defects. Quality should be improved. And how will quality be improved? Quality will be improved when the defects are reduced. So our attempt should be to reduce the defects as much as possible. The reduction in defects is the core analysis behind Six Sigma. The defects should be reduced to the minimum level. So these are the people who are involved in Six Sigma technology. What role is to be given to what people in Six Sigma technology? I'm not going through this role as of now because this is a very straightforward role. So for example, executive leadership should be given, CEO should be given the role of the top leader in case of Six Sigma hierarchy. Then champions are given the responsibility of implementing Six Sigma in the organization, and these champions are generally executive leaders. The upper management are the champions. Executive leaders, what do executive leaders do? They set up the vision for Six Sigma. So who is the person who's responsible for doing thing, and what is the thing to be done in Six Sigma? That is defined by this particular hierarchy. Okay, so there are masters, there are experts, there are black belts. These are all different peoples having different responsibilities in Six Sigma implementation. Green belts, yellow belts, etc. Then Stewart's cycle of plan, do, check, act. So this is a technique which has been adopted by Stewart. Plan, do, check, act. PDCA. Plan, establish the objectives and processes that are necessary to deliver the results. Do, implement these processes of quality control. Check whether these processes and results are according to what objectives you want. Check the results which are attained. Act, apply the outcome for necessary improvement. Whatever necessary improvement you want, you apply your brain on it and act accordingly. Then 5 concepts of quality management. These are important, guys, for managing the quality. There are 5 Japanese concepts which are very, very important. So first is Siri. Siri means sort and organize. In English, it is known as sort and organize. So distinguish between necessary and unnecessary things and getting rid of what you don't need. So see this before Siri, see this after Siri. Before Siri, you had a lot of wastage in your room. After Siri, you had only the important things in your room. So Siri is organize and sort. That is one of the important ways of managing your quality. Quality will improve under this circumstance. The quality will improve under this kind of environment. Then Satan. Satan means neatness and orderly storage. So everything should be at the right place. Okay, everything has a right place, and there should be no wastage. So orderly storage is the key of Satan. So you see this box. All the equipments are there in the proper storage areas so that whenever they are required, they can be retrieved easily. This is the second technology, which is Satan. Then it's Seso. Seso means everything should be clean. Garbage, dust, dirt, leakages should not be there. So you see these two things. You observe. Please observe. In this pic, there is a rusting which has happened. Rusting has happened and it is all dirty. In this pic, no rusting is there. Everything is maintained well. Cleanliness is there. Neatness is there. So neatness is the key of SESO. Then Seketsu. Seketsu is standardization. Everything is to be done in a standardized manner. Every process should be done in a normal standardized manner. So all the departments should have neat and clean workplace, and there should be standard which is developed. Standard means, the cleanliness will happen twice every week. Twice every week, the floor should be wiped off, the table should be wiped off. Twice every week it should happen. So cleanliness standards are developed based on Seketsu. Then Shitsuke. Shitsuke means discipline. You should have disciplined approach towards processes, implementing behavior and habits to maintain established standards over the longer term, managing process of success. This is known as Shitsuke. And guys, very, very important. And someone was asking in the notes also, in the chat box also. Very, very important topic. Please mark this topic as very, very important, because this topic will definitely be there in your examination, either in theoretical part or in practical part. Relevant for theoretical part as well as practical part. Both the parts are relevant in this particular analysis. Dupont analysis. Dupont analysis is a very, very important analysis from an exam standpoint. Now, guys, let me directly take you to the main equation of Dupont analysis. Okay. So ultimately, what do organizations work for? They work for return on equity. What do ultimately the organization want? They want return on equity. On their equity, they should earn high returns. That is the ultimate objective of any and every organization. Return on equity. Now, return on equity can be measured by using a simple formula, which is net profit divided by total equity. Net profit divided by total equity infusion. This is return on equity formula. Now, Dupont has bifurcated this formula into three parts. Net profit margin multiplied by sales divided by total assets turnover multiplied by financial leverage. So net profit margin means net income divided by sales. Asset turnover ratio means sales divided by total assets. And financial leverage means total assets divided by total equity. If I multiply all three, okay, sales get cancelled by sales. Total assets gets cancelled by total assets. And what are we left with? We are left with net income divided by total equity. And this is the formula of return on equity. So according to Dupont, return on equity is a summation of three factors. Net profit margin should be appropriate, then return on equity will be good. Asset turnover ratio should be appropriate, which means sales quantity as compared to total assets should be high to improve your return on equity. And last, financial leverage should be appropriate. Financial leverage should be high to improve your return on equity. So return on equity is a accumulation of three factors: A, net profit margin; B, asset turnover ratio; and 3, financial leverage. This is the formulation of ROE. Now, what says is the company can increase its ROE if it generates high net profit margin, it effectively uses its assets to generate more sales, which means asset turnover ratio should be more, sales divided by total assets should be more. Third, it has high financial leverage. It should use debt, a lot of debt in its capital structure. So financial leverage should be high. If all these three things are high, then return of equity will automatically be high. So in your examination, guys, you will be asked to analyze a particular performance of a particular organization's ROE in terms of Dupont analysis. It means you have to bifurcate the ROE into three ratios, and you have to analyze the performance of each of the ratio to comment on whether ROE is performing well or not. This is the Dupont analysis. A practical question can come from this particular concept. A theoretical portion can come from this particular concept. Both of the questions are possible. That ROE is to be bifurcated into three parts: net profit margin, asset turnover ratio, financial leverage. If you multiply all three, it will yield the same result. It will yield ROE as the answer. Okay. So what I do is I cut sales from sales. Sales and sales will cancel out with each other. Total assets and total assets will cancel out with each other. What we are left with is net income divided by total equity. Net income divided by total equity, which is ROI. So ROI increase or decrease can be analyzed using three components, and these are those three components. And this is the Dupont analysis, which can be asked by you in the examination. And yes, we are done with our chapter number 2 as well, and a lengthy one, guys, a lengthy one. So let me ask all of you after chapter number 2, how's the Josh in the house? How are you feeling now? How's the Josh? Now we are left with only one chapter, which is risk management, which is a small one. Okay. How's the Josh? Yes, we still have a lot of people who are online and are willing to really clear their examination to the fullest extent. They are willing to, work hard towards their desired goals of successfully completing the examination. Thank you for Dupont, Sarji. Yes, welcome, Dheeraj. So, how's the Josh? How's Josh with everyone? How are you? Are you excited for starting the new chapter, or should we leave the new chapter for next class? Should we do the next chapter tomorrow? Should we defer the new next chapter? Should we leave it to the next class, or should we do it right now? Should we do the third chapter right now, which is risk management, one of the most important chapters of your syllabus, guys? Risk management. Should we do it right now, or should we defer it to a future period like tomorrow or day after tomorrow? Should we defer it? Let's see. How many students are saying let's do it right now? How many students are saying let's defer it? Please complete today, Krishna is saying. Shruti is saying right now. Brilliant. Krishna is saying right now. Today only, right now, right away. Dheeraj is saying right now, right away. Good. Sharan saying, Kal kare so aaj kar. Let's do it today. All right, guys. Let's start our next chapter, risk management, after taking a 5 minutes break. Just a 5 minutes break. We'll come back and start our chapter on risk management, which is most important chapter for theory point of view as well as practical point of view. I will not touch base the practical chapter. I will touch base the theoretical chapter. So let's start chapter number 3 in chapter number 4 in just 5 minutes. 5 minutes break. All right, guys, let's gather back and let's start our next chapter, which is risk management. Yes, let's start the next chapter. Let's gather back. We have taken a break, and now let's start the next chapter. And the next chapter is enterprise risk management. A very, very important chapter. And surprisingly, this chapter is important not only from a theoretical perspective, but also from a practical perspective. So from both the perspectives, this chapter is very, very important. Enterprise risk management. All right. This is enterprise risk management. All right. Yes. So let's start enterprise risk management. Before I start enterprise risk management, I need to tell you what do you mean by risk. What do you mean by risk? Now for this, I need some volunteers. Yes, I have Siddharth Pokhrel. Okay, Siddharth Pokhrel is with us. So guys, Siddharth Pokhrel is one of the students of my class. And assumingly, he likes one girl of the class. Okay, he is very fond of one of the girls of the class. And one fine day, he decided to propose that girl. Okay, he wanted a yes from that girl. He proposed that girl with a flower in his hand, with a red rose in his hand. He went to the girl and he proposed that girl that can you be my girlfriend? I really like you. Siddharth Pokhrel is one of the guys who proposed a girl of my class. Now, what was Siddharth expecting? What was Siddharth expecting? Siddharth was expecting that, that girl will say a yes to him. Okay, his proposal will be accepted. This was the expectation of Siddharth. But guys, what can go wrong? What can be the probable, option? What can go wrong? Please write in the chat box. What can happen? What can happen apart from what is expected? What is expected? The expectation is that Siddharth will receive a yes. His proposal will be accepted. Okay. But what can go wrong? What can happen? Otherwise, what is the probability that something else can happen? What is that something else? What else can happen to Siddharth apart from getting a acceptance in his proposal? What else can happen to Siddharth? Being rejected, yes, rejection at worst, absolutely. Arun is right, Shruti is right. Being rejected. So now, what is risk? Risk is not attaining what you have desired for. That is known as risk. Kut gaya hoga. A beautiful slap will receive. Now students are becoming violent and they are going to extremes. Suyog Malpure Singh, a beautiful slap he will receive. Kuta gaya hoga. Dheeraj Kumar says kuta gaya hoga. Kuta means to get reprimanded, to get beaten up. Dheeraj Kumar is saying maar pitai hogi uske saath. Okay, these are the extreme negatives. But what is the point? The point is that risk refers to the probabilities of adverse impact of an action. Whatever action you take, what if the action does not yield the desired result? What if the action yields an opposite result? That is risk. That is known as risk. So risk is that probability of not obtaining the desired results. Whatever results we want, we do not obtain that result. What is the probability of that? That is known as risk. Now, similarly, what do you mean by enterprise risk? Guys, enterprise risk means an enterprise is working towards profit, towards attaining profit. What is the probability that it incurs losses rather? They are working towards certain objectives like customer satisfaction. What if the customer is not satisfied at all? The organization is working towards shareholder satisfaction. What if shareholders are not satisfied at all? There is a risk attached to everything. There's a risk attached to everything. This is known as enterprise risk. So the risk that enterprise does not receive what it desires of is known as risk, enterprise risk. In broad term, risk involves exposure to some type of danger and possibility of loss or injury. In general, risk can apply to your physical health, job security. In finance, investing risk often has a chance that outcome of investment actual gain will differ from the expected outcome. Actual gain is different, expected outcome is different. That is known as risk. So risk is not attaining what you have desired for. That is known as risk. Now, how can you manage risk? How can you manage risk? Number one, you can accept risk. Just accept risk. That is, this risk is obviously there. So when Siddharth goes to that girl, he knows that he has a risk of being slapped or being hit by a sandal and having a black mark over here on his right cheek. So this risk is always there. So first, a way of dealing with risk is you bear the risk. To an extent, you bear the risk. You know that business is risky, so you bear the risk to a certain extent. Then next way is you avoid risk. You avoid risk. Or you avoid taking risky stance. You avoid taking risky decisions. Like, a sailor do not go to high waters because of high tides. There's a risk over there, so a sailor does not go over there. So risk avoidance. You avoid risk. You do not do those activities which are risky. Next is risk minimization. You arrange some ways in which risk can be minimized. So you have fire extinguishers in your office. You have fire extinguishers all around. Fire extinguishers will make sure that even if fire breaks up, then the loss will be minimal. So risk minimization can happen. Or you can share risk. So insurance companies does these things very efficiently. They share risk. So risk sharing is the fourth way of managing risk. So risk management has four elements to it: risk bearing, risk avoidance, risk minimization, and risk sharing. What is the difference between risk avoidance and risk diversification? What is the difference between these two risks? Risk avoidance and risk diversification. Risk avoidance is elimination of threat that can negatively affect the desired outcome. So you totally do not enter into those activities where there is any kind of threat. This is risk avoidance. Risk diversification means you mitigate risk by diversifying. So for example, if I am willing to invest my money somewhere, I know that shares investment is risky. So A, I will avoid investing in shares. Or B, I will only employ a proportion of my investment in shares. Balance I will employ in mutual funds, and rest I will employ in fixed deposits. Okay. So this is the strategy of risk diversification. In risk avoidance, I will not invest in shares at all. I will not invest in risky propositions at all. I will only invest in the safe investments like fixed deposits. However, in case of risk diversification, I will employ in various investments in a different proportion so that my risk is diversified. Risk avoidance strategy is designed to deflect as many risks as possible. We are avoiding the risk. Risk diversification, we are not putting all eggs in one basket. Then it is not possible to 100% eliminate the risk. It is possible to diversify the risk to a great extent. Its aim is to avoid costly disruptive consequences of damaging events, and its aim is to take exposure only in one area. Exposures are taken in different areas so that one is not hurt if something goes wrong. So in this, the damaging event is avoided altogether. Damaging event is avoided altogether. In this particular scenario, damaging event is minimized. Damaging event is minimized, and the event is equally distributed in various other risk also. So now, what are the risks which are faced by an enterprise or even an individual? These are the risks which are faced by enterprise or individual. Political risk, the risk of political events, political parties coming in play. So a war between India and Pakistan will lead to some business risks. Some business might be adversely affected. Korea US dispute which is there, it may severely affect the export trades. So political risk is the first kind of risk. Then country risk, risk which are related to a particular country, event which happens in a particular country. Like the government of North Korea has refined or confined the country into very restrictive norms. North Korea government has confined its country into very restrictive norms. So these are the country specific risks which arise. So because of restrictions, other businesses cannot enter into North Korea. Economic risk, risks which are related to economic climate of a particular country, the economy of a particular country, that is known as economic risk, like growth or rate of income in a particular economy, nations, inflation rate in a particular nation, or stability of prices in a particular nation. So economic risk relates to economic activities. If economic activities do not go well, then economic risk arises. Social risk, so the societal things like religion, like beliefs, like custom affect businessman a lot. So those are known as social risk, which emanate from society's beliefs, the religious beliefs which are there, they are known as social risk, which are there in any country. External risk means situation which are outside the country. So enemy attacks us, or we borrow a lot of money from foreign nation, then that is a risk which is there, external risk. Exchange risk, the currency deflation and inflation happens very rapidly. Dollar is very expensive, euro is very expensive, so exchange risk is one of the major risks which is faced by businessmen. Then business risk, the business in itself is a risky proposition. Sometimes, during corona times, many businesses had ended, right? They had to close, they had to shut down, so business risk is very much there. Financial risk is there. You invest your funds in a particular way, and what if those funds do not reap the benefits that you always wanted? Your funds is invested in a particular company in a particular way, and the benefit is not there. Why does war between two companies affect us if we have no trade with them? Yes, if we have no trade with them, then it will not affect us. But if we have trade with them, then it will affect us, because if US and Korea are at war, then naturally US will employ all its money to buy the ammunitions, and it will reduce its imports from India, say of anything else which is unnecessary, which is luxury. It will reduce import from India because it won't have money to pay. It will divert its money to the ammunitions. So the war between US and Korea will directly affect the trade between India and US. That is the reason. So how company invests its funds, that is also an risky proposition. So if you invest too much of debt, then you are at a very high financial risk. So financial risk is a important risk. Then systematic risk. Systematic risk means if the stock market is moving upward and downwards on a regular basis. This is flow of stock market which happens. This is known as stock market cycle. Okay, if during this stock market cycle your business prices deflate and increase, then this is a normal systematic risk which will happen. Systematic risk will happen. Your company shares will undergo upward and downward movement in their shares. This is systematic risk which will happen. It is unavoidable. It is due to uncontrollable factors. Market is moving up and down. Naturally, your shares, without even your interference or without even your making any adverse decision, may go down, terribly go down. Demand supply. Unsystematic risks are the risks which are there because of controllable factors. They are there for known factors. Like, if GST rates go up or income tax rates go up, that definitely it will be a dent in your pocket. So it will be a dent in your pocket, your profits will reduce. Unsystematic risk is that. Then market risk, the changes in demand and supply of market goods, your goods which you are selling, changes in their demand and supply will definitely affect the market. Then interest rate risk, interest rates may vary from market to market. So interest rate increases sometimes they're decreasing, and there are floating interest rates which are there. So any kind of interest rate variability will affect the businessman, because the expenses will rise. Purchasing power risk, which is inflation risk. If inflation goes beyond a particular limit, then purchasing power will be at a dent, right? So petrol and diesel rates in India are very, very high. They have reduced the purchasing power of people, because oil is an essential element. People will buy oil. They will cut down on other expenses. So inflation has affected the purchasing power of the people. Default risk, that is non-payment of interest and the main loan repayments. Okay, you have given loan to someone and he does not repay the loan to you, or bank has given loan to someone and he does not repay loan to bank. It will be a loss for bank. So that is the default risk. Liquidity risk. Liquidity risk is that you want to sell your assets and you want urgent money. You won't find good buyers who will buy your assets quickly or buy your inventory quickly. That is the risk which is there. Liquidity risk. In an emergency situation, you will not be able to raise money. That is the liquidity risk. Callability risk. This is a very important risk, guys. Investments come up with call option. Call option means before maturity of the investment, the investor can choose to withdraw money. In that case, business has invested that money in some project. How can they withdraw money from that project and give it to the investor? That is a problem. Callability risk. If your investments are callable or are dilutable at a before the maturity period, the business cannot invest those funds in some long-term projects. Business has to keep some liquidity intact with it to make sure that if someone calls for money, it is payable to that particular person. So callability risk. Convertibility risk. This risk arises in case of convertible bonds and convertible preference shares. So, convertible preference shares are converted into equity shares after a point in time. Convertible bonds are converted into shares after a point in time. What is the possibility that this conversion is a problem? So, the investment may be converted into common stock at a time under terms and conditions, which is harmful to the investor's best interest. So, this convertibility is a risk. Industry risk, whatever risk is faced by the entire industry, like raw material is scarce in a particular industry, it is faced by all the companies which are doing work in that particular industry. That is an industry risk that will impact your business also. So there are certain industry risks. Operational risk, the systems, the processes, the technology might become obsolete. There are some errors which might creep in. This is known as operational risk. So these are various types of risk which are faced by any businessman. Now, how do you manage risk? So guys, risk management includes these 4 processes. You identify what risks are there in your business. You assess what is the likelihood of occurrence of this risk. What is the probability that this risk will occur to me? So for example, I am developing steel products and I use high voltage of electricity to burn that steel. So there's a possibility that fire may break out in my plant. So what is the probability that fire may break out in my plant? Then what can you do to control the impact of that risk? Then we need to monitor the situation. We need to monitor that risk is being controlled. So identification of risk, assessment of risk, control of risk, and monitoring that risk is done. So objective of risk management is to anticipate the uncertainty and degree of uncertainty of events. We need to anticipate what risks are there. We need to anticipate that. We need to channelize events to happen the way they are planned. We will try to minimize the risk by not taking any negative step. Rectifying deviations from plan. If any risk burns out, if any risk appears, then we will make sure that we rectify that risk which has occurred. We ensure that objective of planned event is achieved by alternative means. We'll search for alternative. When our risk has arisen and the first alternative is not working fine, we try to find alternative. Like if a fire breaks out, we try to not to stop our production. We start production in some other premises. Okay. In case expected event is frustrated, make the damage minimal. Now, what if the risk is there and the risk has outburst? Then damage should be minimal. We should quickly try to curb that fire and we will try to stop damage as far as possible. So we'll curb the damage. Ways to manage risk. How do you manage risk? What are the ways to manage risk? Number 1, risk pooling. Pooling means accumulating together. Okay. So what is role of an insurance company? I'll tell you the role of the insurance company. So there are many people who take insurance. Premium is $100 per person. Okay. Premium is $100 per person, which is collected from 1 lakh people. $100 per person, which is collected from 1 lakh people. We have a risk pool of $10 million. Suppose out of these 1 lakh people, 100 people's houses are destroyed. Then from this fund, we extract money for 100 people whose household are destroyed. Okay. So people are paying 100 rupees as premium. Now suppose out of these 1 lakh people, 100 fires are destroyed, 100 houses are destroyed. We have taken $100 per person. Okay. 100 houses are destroyed and the price to build one house back is suppose $1,000. Okay. Suppose the price to bring back one of the house is suppose $1,000. Okay. So what is the total cost of this insurance company? The total cost is $1 lakh. $1 lakh is the cost. And what is the cost pool? What is the premium pool? The premium pool is $10 million. $10 million. And the cost is $1 lakh. So difference between the income and the expenses will be profit. This is how the risk is pooled together. The profit which is there will again be distributed to all the remaining people in different ratios. This is how insurance works. This is a very good example, guys, which is given in my book. Now you can refer to my book as well. This is risk pooling which happens. 1 lakh people have given $100 each for protecting their house. 10 million is the risk pool which has been accumulated. The funds which have been accumulated is 10 million. Suppose 100 fires are 100 houses are destroyed. One destroyed house, the compensation which is to be paid is $1,000 to be each other person. $1 lakh are paid as compensation. The difference between $10 million and $1 lakh will be the income which is there in case of this insurance. This is known as risk pool. This is what insurance company does. So the first way of managing risk is pool all of your risks, contribute something to the common pool, and then you give risk satisfaction to a particular person. No, definitely they would invest this money, definitely. So the 10 million pool which has been which is there, this will be invested, and some more money will be earned from this particular $10 million. But I'm assuming that they are not investing. I'm assuming that they are not investing. Even when they are not investing, even then it is a profitable proposition. Even when they are not investing, even then it is a profitable proposition. That is what I'm trying to make a point. Risk is being pooled. I'm not talking about investment income being earned. That's okay. Investment income will definitely will be earned. Even if it is not earned, then also your risk is absolutely managed by pooling the risk of 1 lakh people together and giving compensation to the people who face the risk. Okay, so this is risk pooling. Then risk diversification. You do not invest in one area, you invest in many areas. That is risk diversification. You do not invest only in shares, you invest in shares, you invest in mutual funds, you invest in debentures, you invest in government bonds. So diversification happens. So you invest in stocks, you invest in commodities, bonds, cash also you keep, FD also you keep. This is diversification. Risk is reduced. So even if entire amount which is invested in shares and commodities is wasted, even if this entire amount is lost, then also your this amount is safe with you. Even if this amount is lost, even then this amount is safe with you. That is known as diversification. Ruin theory. Now ruin theory is very, very important theory, guys. Ruin theory is suppose in the insurance business, over here we had taken that only 100 houses are burned. Over here we had taken that only 100 houses have been burned. What if there is a major problem with the city, and what if 90,000 houses are burned? What if 90,000 houses are burned? Then guys, we have to give $1,000 to 90,000 houses, and then this insurance company will be bankrupt. Insurance company will not have money to pay. Over here we had assumed that 100 houses are burned. What if 90,000 houses are burned? So this probability, what is the probability that entire money which was collected with the insurance company is to be given as the claim of the investors, of the premium holders? What is the probability? What is the stage at which the insurance company will get ruined? This is known as ruin theory. So ruin theory will tell you till what extent can an insurance company bear the risk. Beyond that point, insurance company will not be able to bear the risk. So that is the ruin theory. Ruin theory is the collective risk theory. When claims are more than the premium, for an insurance company, capital becomes negative and we say ruin occurs for the insurer. So it is an indication of soundness of insurance solvency. So probability of ruin should be ascertained. If the probability of ruin is high, then the risk is high. So your probability of ruin should be minimum. For an insurance company, probability of ruin should be minimum. That is the concept. Okay. Risk mapping or risk analysis. So guys, an effective way to manage risk is, please jot down your risk. Please map your risk. So over here, I've given two axes, y-axis and x-axis, probability of risk and impact of risk. If the risk is less on probability and less on impact, this is the green area. High on probability but less on impact, green area. High on impact but less on probability, green area. So these are the green areas which are safe areas. Risks which are there in these areas, those risks might be ignored. Those risks might be not be taken care of in a very strong manner. But the risks which are denoted by yellow zone and red zone, they are to be taken care of very, very minutely. Because a risk which probability is high and impact is also high, probability is also high, impact is also high, that risk is very, very difficult to manage once it occurs. So the high attention of management is required in these risks, red risk and yellow risk. So risk mapping and risk analysis is very, very important to manage your risk. Your risk will be managed. Benefit of risk mapping, it tells you about the significant risks which are there. It enables delivery of solution and services to manage that risk. It serves as a strategic business planning. You can plan your risk according to this particular risk mapping. Then you assign clear responsibility to individual for their particular risk areas. Opportunity to leverage risk on a competitive advantage. You can take steps to minimize that risk as compared to your competitors. Development of strategic approach. You develop the strategic approach to mitigate the risk. Support design of client's finance insurance program through development or effective retention level, scope of coverage, etc. Then next is risk retention. So guys, sometimes some companies choose to retain some risk and not do anything about it. So for example, green risk, we had chose to retain this risk and not do anything about it. So risk retention is another way of risk management. Then risk reduction. Risk reduction can be termed as mitigation of all conditions that are leading to hazards. This is synonymous to risk avoidance. We don't do those activities which lead to a particular risk. We don't do that activity at all. So mitigation of all conditions that lead to risk is known as risk reduction. Then guys, what do you mean by corporate risk management? Corporate risk management means a risk management technique which is designed to identify potential events that may affect the entity and manage that risk. So what risks are there for a particular entity? We need to identify that and we need to manage the risk of those particular entities. That is known as enterprise risk management. A sense of enterprise risk management is to build an effective risk management tool and to be significant driver of value. So we need to develop a mechanism or a method to minimize the risk. To minimize the risk. We need to develop an effective risk management mechanism to minimize the risk. We need to ensure that risks and opportunities are systematically identified. We need to design and implement the ERM infrastructure. What is the risk management infrastructure? We need to design and implement it. Okay, so these are the benefits, needs. Okay. So COSO and GIS, these are the two important elements of your enterprise risk management, guys. So guys, what is COSO? COSO is Commission of Sponsoring Organization of Tradeway Commission. This is COSO, and COSO has developed a framework whereby a management of a particular company can manage its own risk. Okay. It's a comprehensive framework and a guidance on enterprise risk management. How to manage your risk? It's a guidance. COSO is a guidance. What does this framework consist of? Framework says that you first set your objective of risk identification. Be aware of the risk that is arising in your organization. Then event identification. What event leads to that risk? What will happen which will create that particular risk? Organization must identify internal and external events that affect achievement of its objectives. Risk assessment. What is the impact of risk? If the risk happens, then what is the impact? Monetary impact. Risk response. What is the action to be taken if that risk happens? Control activity. What are the policies, procedures to ensure that risk is mitigated, risk is reduced? Information and communication. The information should be clearly floated in the lower level management. Data should be given to the management, communicated in a format and time frame to enable the managers to carry out their responsibilities. Then we need to monitor and modify the system which we have for risk management. Then what is GIS? Geographical Information System. So Geographical Information System is a risk management technique which is used to avoid natural hazards, like where will the earthquake happen or where will the probability of flood happen. Okay, so that predicting the risk of natural hazards and possible impact is known as the geographical information system. So we need to predict the risk of natural hazards and possible impact. This is geographical information system. Okay, very important concept, guys, from an exam standpoint. Also a very important concept, value at risk. Okay, so suppose I have invested 2 lakh rupees in the shares of Reliance Industries Limited. I had invested 2 lakh rupees in the shares of Reliance Industries Limited. 2 lakh rupees, the share price is 2000 rupees. So I have got 100 shares of Reliance Industries Limited. 100 shares of Reliance Industries Limited is there. Now, the past trend has shown that Reliance Industries Limited shares have at most gone down to the extent of 800 rupees. Never ever has the Reliance Industries Limited share has went beyond 800 rupees. Never ever. So what is value at risk? What is my value at risk? At most, I can lose 1,20,000 rupees out of this 2 lakh rupees. So value at risk is 1,20,000 rupees. What is the maximum loss that I can incur because of this risk? This is known as value at risk. What is the maximum loss? 1,200 rupees can be the maximum loss, because never ever has the Reliance Industries shares moved down to below 800 rupees. This is the concept of value at risk. A very important concept from an exam standpoint. It is one of the popular methods of measuring financial risk of investment. It estimates how much a set of investment might lose given normal market conditions. In a set time period, such as a day, VAR is typically used by firms and regulators in financial industry to gauge the amount of assets needed to cover possible losses. There are different types of VAR: long-term VAR, marginal VAR, factor VAR, etc. So this is the VAR. Now comes a very important sector risk, guys. Banking industry risk. Banking industry risk means the risk which is prevalent in a banking industry. What risks are prevalent in the banking industry? The risks are very, known to everyone. First is the non-performing assets risk, which means that the loans which are given by bank to the third parties are unable to repay that loan. This is known as the risk of non-payment. And this particular risk can be curbed by assessing the credit worthiness of each and every loan person who's taking the loan. We need to assess the credit worthiness of that person, and to take something as mortgage. Some asset of that particular person should be taken as mortgage. So this is the first risk, which is the risk which is related to repayment of loans. Second risk which the banking industry faces is that the deposits which it has. Deposit means fixed deposits or current deposits. The deposits should not be less than the loans that they give. There should be an adequate ratio which should be maintained by the company for their deposits versus their loans which they give. So deposits should always be higher than the loans which are granted to the third party. There should also always be a ratio which is maintained between the deposits which are taken and the loans which are given. So this ratio has to be very strictly maintained, and it has to be maintained in a very safe manner. Deposits should always be higher than the loans which a company is giving to its lenders, to its loan holders. So these are the risks which are faced by a banking industry. So to curb these loans, there are capital adequacy norms, which means how much percentage of capital can a company give as loan, capital adequacy norms. And this was proposed by Basel committee. Basel committee has issued directives to the banking sector to ascertain what are the norms which are to be followed by banks. So this was Basel 1. Basel 1 was introduced in 1988 and was amended in 1996. Basel 2 was introduced in 2006, and Basel 2 was little more strict. Basel 3 was introduced in 2012. Banks were primarily exposed to credit risk. They often held illiquid portfolio of loans supported by deposits. So the loans were illiquid, which means there was no expectation of loans coming back. Okay. And the deposits were equal to the loans. So suppose a bank has deposit of 10,000 rupees. Okay. If it gives the entire, say out of 10,000, if it gives 9,000 as loan, and we know that loan is not going to be repaid, then whenever the person who has deposited in bank, whenever he will ask for his money back, would I have money to repay that amount? Answer is no. So banks were primarily exposed to credit risk. They often had illiquid loans. Illiquid loans means loans which are not repayable, supported by deposits. Deposits were there, and loans were given against that deposits. So this was the problem with the banks. Such loans could be liquidated rapidly at the time of emergency. This placed bank at a risk of decline. So banks were facing this problem. Then there was introduction of liquidity coverage ratio and net stable fund ratio. Liquidity coverage ratio means the bank has to maintain certain amount of liquidity, certain amount of cash with itself. It cannot give entire amount which is received as deposit as loan. It cannot give. It has to maintain certain amount of liquidity. Bank has to maintain certain amount of liquidity. That is the requirement of liquidity coverage ratio and stable funding ratio. So LCR is the ratio of liquid assets to net cash flow. Net cash outflow versus liquid asset, there has to be a ratio for short-term liquid management, and NSFR is the ratio for long-term liquidity mismatches. RBI has prescribed these ratios for every commercial bank operating in India. Then Basel Committee reforms, guys, we have studied that there are Basel Committee which had strict ways of dealing with credit issues which are there with bank. Let us talk about Basel norms. Basel 1, 1988 it was introduced, 1996 it was amended. Okay. What did it say? What did Basel Committee say? It dealt with basic deposit taking and lending function. So whatever deposit bank is taking, and as compared to it, whatever it is lending, there has to be a congruence between these two activities. So Basel Committee, gathered the congruence between these two activities. Bank assets like deposits, loans are given risk weight. So whatever deposit bank will take, it will invest either in some securities or give loan to people. Okay. So the risk which is attached to the securities, which the amount which is invested in securities will naturally be low, and the risk which is attached to loans, giving loans, is naturally high. So I'll give you an example. Bank received 10,000 as fixed deposit from a customer. It invested out of 10,000 rupees, it invested 8,000 rupees in some bonds, government bonds, which are absolutely safe, and 2,000 rupees it gave as a loan. Okay. This is the transaction which happened with them. Now, guys, this is a non-risky investment. This is not a risky investment, but this investment is a risky investment. Bonds is a non-risky investment, but giving loan is a risky investment. So the risk weight is given to government bonds. The risk weight was given as 0. There is no risk in government bonds. There is no risk in government bonds. No problem if you have given 8,000 rupees out of the deposit to government bond. Even if you give 10,000 rupees to bond, we don't have any problem. But we have a problem where you give loan to G10 bank debt was weighted at 10-20%. So if you give loan to G10 government debt was weighted at 0. G10 bank debt, if you give loan to G10 are the 10 countries which are forming part of the conglomerate, which is there for South Asian countries. Okay. So if you give a loan to government of G10 countries, no risk. If you give the if you purchase bonds of G10 banks, then there's a risk of 20%. And if you give it as any other thing, then the risk is 100%. So on this 2000, the risk is 100%. On this 2000, the risk is 100% because you have given loan to a third party. What if you had given some amount to the G10 bank? Then that risk would have been 20%. 20% is the risk. So bank were required to hold 8% of risk-weighted value of assets. So bank has to hold 8% of risk-weighted value of assets. Guys, let us take a simple example to demonstrate it. Okay. So an Indian bank is there. It has got a deposit of 10,000 rupees. Okay. It invested in 3 sources. Number 1, 6,000 rupees G10 government bonds. 3,000 rupees G10 bank bonds. 1,000 rupees other debts. Okay. Now the question is that how much percentage should the bank maintain as liquid assets, as the assets which it should not give to anyone else. Okay. So government debt is 0% risky. Bank debt, G10 bank debt, is 20% risky, and other debt is 100% risky. So what is the weighted risk which is associated with this investment which bank has done? The rated risk is 3,000 multiplied by 20%. 3,000 multiplied by 20% is 600. 600 plus 1,000, 1,600 is the weighted risk which this bank is taking. Is the weighted risk which this bank is taking. Now, guys, What is the norm of Basel committee? Basel committee is saying, okay, out of 10,000, you have to maintain 1,600 as cash. Sorry, not 1,600, but 8% of 1,600. What is it given? 8% of 1,600. Okay, let me change the slide also. I think you cannot see this slide. Let me share. Okay. Now can you see the slide? Now can you see the slide? Okay. So bank has deposit of 10,000 rupees. Bank has received deposit of 10,000 rupees. Out of the 10,000 rupees, it has invested 6,000 in government 10 bonds. It has deposited in G10 banks. It has deposited 1,000 rupees in other debts. Okay. So G10 government is risk-free, 0% risk. G10 bank is 20% risky. So I multiplied it by 20%. Other debts is 100% risky. So what is the risk weight? Risk weight is 1,600. How? 20% of 3,600, 100% of 1,000, 1,000. So 1,600 is the risk weight. So, 8% of risk weighted value of assets. So 1,600 multiplied by 8% is the liquidity which this bank needs to maintain. 8% of 1,600 bank cannot give to anyone, cannot invest, it has to keep with itself. 8% is the risk weighted factor. That is the ask. Okay. Harmeet Singh, definitely I will talk to you today. I was engaged in these marathon videos now, that is why I'm not able to talk to you, but I will talk to you today. All right. So banks were required to hold 8% of risk weighted value of assets. Risk weighted value of assets multiplied by 8% is the hold. In 1990, Basel norms were amended to include bank capital requirement of market risk portfolios. This implied that Basel norms were made applicable to non-banking companies also. So the Basel norms in 1990 were applicable. Earlier to 1990, the Basel norms were only applicable to banks. After 1990, the Basel norms, Basel 1 norms were applicable to NBFC also. NBFC is non-banking financial corporation, which are not doing the activities of deposits and loans in a proper manner, but which are providing some funds, some other activities which are financial activities. So Basel norms were introduced for NBFC also in 1990. In 1993, banks were required to have independent risk management function. In 1993, Basel committee required an independent committee within each bank who will manage the risk. Independent risk management function should be there. A department should be there who will look after the risk management of that particular bank. In 1993, this happened. Further, the amendments also propose minimum capital requirement of 10 days, 95% of value at risk assets. So whatever is the value at risk which is there on the assets which are invested by the bank. So in our example, the investment was made in G10 banks, then G10 government, then other assets. Whatever is the value at risk, we had already discussed value at risk. Whatever is the value at risk, 90%, 95% should be maintained as capital in the banks. Guys, then they were introduced Basel 2. They were introduced in 2006. Now, Basel 2 were much more strict than Basel 1. Basel 1 were relaxed. Basel 2 were more strict. So, Basel 2 had 3 pillars, okay? Basel 2 had 3 pillars. Pillar number 1, minimum capital requirement. So, minimum capital the banks needs to introduce in their business. Their business cannot be funded by debt. So, minimum capital is to be introduced. So, for market risk, banks have to report capital requirement for interest rate risk, equity position risk, foreign exchange risk to the regulator. So, in Basel 2, first requirement was that you should have adequate capital to take necessary risk. Capital requirement should be there. So, what should be the capital requirement? We'll be studying in our further bullets. For credit risk, banks in India currently follow standardized approach and they report risk-weighted asset for various credit exposures. So whatever credit exposure a business is having, they have to disclose it to RBI. They have to disclose it to regulator. Amount of loan multiplied by risk weight multiplied by 9% is the capital required to be held against any given loan. So whatever loan you are giving to anyone, against that you have to keep this much amount of capital with you. So capital, capital means equity capital, the capital of the owners. Owners should have a say in the banking business. The risk weights assigned by the regulator depends on the credit rating of the borrower. So risk weights are assigned just like weights were assigned in Basel 1. Risk weights were assigned in this particular asset category also. Banks also use various credit conversion factors, convert their off balance sheet exposures. So guys, certain exposures are off balance sheet. For example, guarantees. So banks sometimes give guarantees on behalf of their clients. Now, just giving guarantee does not is not treated as liability in the books of accounts. Just giving guarantee is not a liability in the books of accounts. But while assessing risk, these guarantees will also be taken into account. The guarantees which bank gives on behalf of their clients, these guarantees will definitely come as a risky matter in the risk management schedule. Okay, so banks have to use various credit conversion factors for managing their off balance sheet risk. Off balance sheet risk means the risk which are there not in balance sheet, but they are there with the bank, like giving guarantees. Then the second procedure is supervisory review procedure. So under internal capital adequacy assessment procedure, there was ICAP. Credit institutions must have effective system and process to determine the internal capital on an ongoing basis. So there has to be a review mechanism within the bank to ensure that their capital is adequate at all times. There should be a review mechanism, a robust review mechanism should be there. Under the supervisory review evaluation process, it is proposed to evaluate bank's risk profile to assess the qualitative aspect of each of the bank. So again, guys, along with defining the monetary criteria of fixing a percentage of capital which is required against each asset, along with doing that, the bank has also, the Basel norms have also determined that there has to be supervisory review process in each of the bank to ascertain the riskiness that should be there. And market discipline means that, on the disclosure requirements should be done by each bank of what is the value at risk, what is the capital that they are placing in the bank, what is the assets riskiness which is there in the bank. So all these things should be disclosed. So market discipline means disclosure requirements by the bank to complement the minimum capital requirements and supervisory review process. So whatever is the result of minimum capital requirement and supervisory review, that is to be disclosed in the balance sheet of the bank. Purpose is to ensure greater transparency of bank's activity. Pillar 3 do not entail additional capital requirement but maintains publication of key data. Pillar 3 is that you have to publish your key data in form of your notes to accounts, etc. in the financial accounts. Now, guys, last is Basel 3 norms. They were introduced in May 2012, and they are the current norms which are in prevalence. They are the current norms which the banks have to follow regarding their liquidity requirements. So, what are the amendments which were there in Basel 3 norms? The RBI new Basel 3 norms regulations are as under: common equity ratio. The equity capital and disclosed reserves to risk weighted average ratio should be at least 5.5%. Again, guys, common equity has to be maintained by the businesses. Business have to have common equity. The say of the shareholder should be more in banking business. It is not that, bank will take loans and funds from other organizations, start a bank, and then they turn bankrupt. This should not be the case. So common equity should be at a certain level as compared to risk weighted assets. So there has to be say of the shareholders in the banking business so that they don't run away in case anything wrong happens and they take liability and onus of it. Then minimum tier 1 capital should be 7% of total risk weighted assets. So the total capital of the bank should be at least be 7% of the total risk weighted assets. Capital means equity as well as debt. There should be predominance of common equity. Common equity should be at a very large level. Common equity 78.5% of tier 1 capital, and total tier 1 capital should be at least 77.58%. So guys, capital means equity and debt. Okay. Now the debt equity ratio that should be there in tier 1 banks, it should be common equity should be 78.57% and the debt should be the remainder. So common equity 78.57% of tier 1 capital, and total tier 1 capital should at least be 77.58% of the total capital. So, the banks are divided into various tiers. So, tier 1 states, Delhi, Mumbai, Kolkata. Tier 2 states, which are little less, progressive, little less developed states. Then tier 3 states, which are very, very backward states. Okay. So, the bank has to maintain its capital according to the tiers where it has its branches. So, these are the rates which are there in tier one category states. So they have to maintain capital, guys. At the end of the day, they have to maintain equity capital at a very reasonable level. The bank cannot operate from the loans that they receive or the grants which they receive. Bank cannot operate in that way. They need to maintain capital. A good capital base is to be maintained by bank. So these are the LCR and NSFRs which are proposed by Basel 3. So what do we remember in all these Basel norms? Guys, the Basel norms 1, 2, 3, you first of all should remember the year in which they were introduced. Then the basic concepts, guys. Now the basic concepts means, in Basel 1 norms, you can learn these risk weights. These risk weights are very, very important. You learn these risk weights are important. Then you learn that in 1990 the Basel norms were also applied to NBFCs. You remember these facts. Then VAR, 95% of VAR should be the minimum capital. You should remember that. So these important points you should remember for every Basel committee amendment, because in examination this can come as a say 4 marks or a 3 marks or a fill in the blanks. Fill in the blanks can also come from this particular category. Applicable for small fund banks as well, because so many cases of bank band hona. Yes, it is applicable for small funds bank as well. Small fund banks are they may be categorized as NBFC. Even if they are categorized as NBFC, then also it is applicable on small fund banks as well. Now the last topic of our syllabus, guys, of SPM theory, corporate failure. Now, despite of working hard, despite of promoters giving their heart and soul to the businesses, it is not necessary that all the businesses work well. All the businesses work well. They turn into losses, they turn sick. So now to assess corporate failure is a very, very important aspect. And when an organization is moving towards failure, assessing that aspect is very, very important. How do we know that our business is moving towards failure? Future of this business is fail. How do we know that? That is the point of contention in this particular topic. So it refers to companies ceasing or shutting down operations following its liabilities. So when the companies cease its operations, because its liabilities are much more than its assets, when the company ceases its operation, when the liabilities are much more than assets, it is known as corporate failure. So what are the indicators of corporate failures? Low profitability, high gearing ratio. Gearing ratio means debts are much more than equity. It is a cause of concern. If debts are much more than equity, is a cause of concern. Low liquidity. Low liquidity means current assets are very less than current liabilities. These are indicators of corporate failures. Now there may be technological causes. What can probably go wrong? Technology may probably go wrong. So if the organization has a failure to upgrade, it does not upgrade itself, then it will lose out on business. So technological causes are there. Working capital problems are there. Liquidity problems are there. That the working capital, that is funds which are required to manage short term daily operations, they are very, very low. Economic distress. Economy is a failed economy. Like during corona time, the economy failed miserably. At that point in time, the due to economic failure, the businesses have shut down. So economic distress. Mismanagement. This is one of the most important reasons. The internal mismanagement of the organization, internal dispute between board of directors, can be cause of corporate distress. Over expansion or diversification. You have forgot about your core specialty and you have diversified a lot. You produce a lot of products. That is a problem for corporate distress. Fraud by management. Management itself has done some fraud, due to which corporate has collapsed, like a classic case of Satyam. In case of Satyam, the management Raju Mahalingam had himself created situation where he has done fraud, and the corporate led to a failure. Then poorly structured board. There is a board of directors are not structured properly. They lack necessary competence. And then financial distress, that the company is running into losses. The incomes are less, expenses are more. That is the reason of corporate failure. So because of any of the reasons, the failure can happen. Okay. Project formulation. Project is not a very difficult aspect. Yes, this is very, very important. The models to predict corporate failure, important from a practical standpoint, not from a theory standpoint. A practical question from Z score NCAER can come in your examination for sure. So this is important from a practical standpoint. Okay. NCAER model number 1, it focuses on 3 aspects. If these 3 aspects are working fine, then the company is a non-distressed company. Then the company is a non-distressed company if these aspects are working fine. If these aspects are not working fine, that company is a distressed company or a failed company. Corporate failure is there in that particular company. So these elements are cash profit, that is profitability, net working capital, net worth position. Okay. Please do practical question of this NCAER. I've done it in my class. Altman Z score. Now please understand, Altman Z score has 2 variations, variation of 1968 and variation of 1988. Okay, these are the 2 primary variations. 1983, these are the 2 primary variations which are there in Altman Z score. You have to see both the variations. Okay, so Altman Z score 1968 is driven by this formula. Now the difference is that in 68 model, market value of equity is there. However, in 1983 model, the book value of the equity is there. That is the only difference between 83 and 68 model. And in the examination, you will be given how to solve the question, whether from an old method 1968 model or 1983 model. And these are the analysis that you need to do after computing your Z score. After computing your Z score, you need to see whether Z score is below 2.99, above 2.99, between 2.99 and 1.81, and below 1.81. These 3 values of Z score will determine whether your firm is a non-failed firm, your firm is a failed firm, or your firm is a mix of both. This will be determined by this equation. Similarly, 1983, there's a different formula to it. Of course, you have to learn this formula. Of course, you have to learn both the formulas. Again, the limit is 2.9, 1.23. These are the limits which are there. Then guys, there is another Z score which is used for privately held companies. This is seldom asked in the examination, so less important. But yes, the scorecard is very small in this particular aspect. Only 4 aspects are there, and the score is dependent on 2.60 variability. 2.60 is the variability of Z score in the third model. Third model is rarely it will come in the examination. Mostly first and second model will come in the examination. So yes, you have to learn the formula very, very carefully and perform questions also, because it will definitely come in your examination. The questions will definitely come in your examination. Where are your latest marathons? Forecast audit. They're there on the YouTube channel. Go on the playlist of cost audit, cost and management audit. I've taken the marathon of practical topics also, so you can take over there. All right, guys. So that's all for this particular session. And yes, we have been able to complete the entire theoretical portion of SPM. And it was really important portion because it will command a weightage of above 20 marks in your examination. Today's lecture will definitely fetch you above 20 marks in your examination. So you will definitely be able to fetch above 20 marks in your examination if you complete the today's session thoroughly. And yes, those students who have given test series regularly. So for past 3 months, we were having test series for CMA final students. Those students who have given the test series regularly, you need not worry. You are already in a very, very amazing condition, and you will be definitely be able to score 80 plus in cost audit as well as BVM, SPM. So yes, guys, before we move to the end of this section, please like this particular video. Please hit the like button and do subscribe to the channel if you are new to the channel. And yes, be connected with me. Even when your result comes, just tell me. I'm eagerly waiting for that message from you. Sir, I became a CMA. I'm eagerly waiting for that message from you. Soon as the result is out, do not forget to message me. Sir, where should we message you? You can message me on my number, and my number is 96. Okay, my number is written over here on the screen. You can see my number. This is my number. You can message me on this number after qualifying. My number is there on the screen, 9643929913. Please message me on my number. Sir, we became CMAs, or sir, we got 80 plus in cost audit, or we got 80 plus in SPM BVM. I'll be the happiest person on this earth to know about this information of yours. So yes, signing off. It was really a wonderful session with all of you of SPM theoretical portion. I hope you got benefited out of it. I've marked certain important elements also of the book out of all the theoretical chapters, guys. So yes, We'll meet in our subsequent sessions. Till that time, all the very best and happy studying and happy exams giving. And guys, one very important information, please check your examination centers. So for certain South Indian territories, certain South Indian states, the Institute of Cost Accountants of India have changed the exam center from one place to another place. So do again check your examination center whether your examination center is same as the old center or has it been changed. So do check it, and if your examination center has changed, then go to the revised examination center. You might otherwise be harassed. Okay, please check your examination center once again. All the very best and happy studying. Bye bye. See you.